of 2008, and that call came in to a different Treasury Secretary. When that call came in, not to say, listen, you got two choices here. Either you're an unregulated institution and you're running yourself, as Marcus said, in this world where extreme risk leads to bankruptcy. That choice means you're on your own. Or else to say, oh, you're a bank holding company and you've just failed. Let me give you the number of the FDIC. Right? Those choices led inexorably to January 6th, in my view. And they've also led to a situation where we get nowhere near the bang for the buck we should be getting in terms of macro effect from quantitative easing, which in my view is the right policy executed without the
Maybe that's a good place to stop and wrap up since we're about a minute over time here. But Damon's got a talent for cliffhangers. One note I did want to make, Drexel Burnham, there's a great book called Predator's Ball about that whole episode, including an anecdote about that Treasury Secretary, Nicholas Brady, and his role in trying to undermine Paul Volcker's attempt to quash leverage buyouts by using some of the Fed's regulatory authority. So,
Graham, I'll give it back to you.
All right, thanks, Damon. So great, wonderful discussion. And now, Erik, I believe it is back to you. Thanks to all of our panelists.
Yeah, thank you to that last panel. That was amazing. I could listen to all of you all day. This is my only regret from organizing the conference, because I'm having to squash so many superstars into small blocks of time, but thank you all. We are going to turn next to consumer financial protection. So one of the things that is often forgotten about Glass-Steagall is one of the original rationales for separating banks and securities firms was conflicts of interest and reducing them. And the New Deal Congress didn't think about consumer financial protection the way we did. We didn't really start thinking about consumer financial protection, at least in the academy, until some of the architects of the CFPB started to bring it to our attention. The CFPB was one of the signature successes of the Dodd-Frank Act. A number of people in this conference, including in this panel, were present at the creation. So this next panel will talk about the implication of financial conglomerates for consumer financial protection. And I'm going to turn it over to Adam Levitin, who is the Anne Fleming Research Professor and a professor of law at Georgetown, and one of the most intimidating legal minds that I know in the academy. So take it away, Adam.
Thank you, Erik. Good afternoon, everyone. As the little name in the box says, I'm Adam Levitin. I'm a law professor at Georgetown. And I'm going to speak for a few minutes to kick things off, but the real feature attractions here are Raul Carrillo and Chris Peterson. Raul is the Deputy Director of the Law and Political Economy Project and an Associate Research Scholar at Yale Law School. And Kress is a law professor at the University of Utah, and most recently, the Democratic gubernatorial nominee in Utah. He has previously held various positions at the CFPB and Department of Defense, and I forgot to mention that Raul previously served as special counsel to the enforcement director at CFPB. So I want to start with a few words of really deep and true appreciation for Art Wilmarth. My first interaction with Art was when I was a rookie professor, and this was in 2008. I had just finished my first year teaching. And I got a paper accepted at a junior scholars conference that Art had organized with Pat McCoy and Heidi Schooner. And that conference in the summer of 2008, it was right before the storm broke. And it was a formative moment for me personally in my career. Up until that point, I had thought of myself as a bankruptcy scholar. That's kind of the work I had been doing. I had a paper that was kind of consumer protection-ish, but I was really thought of myself as a bankruptcy guy. And I really didn't see very much that was going on in the financial regulation space as being, it didn't seem like it was an active and interesting space, especially. I didn't know who made up the field, and part of that was my ignorance, but part of it was maybe a sleepier field at the time. And I came out of that Junior Scholars Conference feeling just with that I had been transformed in terms of what I wanted to do with my scholarship. There was an amazing group of junior scholars there. Can't remember if Erik was there, but certainly Anna Gelpern, Saleh Omarova, Mercer Baradaran, among others were all there. And I came out of it with a sense that this was actually a really exciting field and I had a vision of where my work would fit into the field. And maybe most importantly, I had a sense of who the figures were who were defining and nurturing the field at that point. And first and foremost among them, really the dean of the field was Art. And Art has generously and gently mentored and encouraged junior scholars. And he's been an absolutely encyclopedic resource on everything remotely related to banking regulation. He's been the pater familias of the field. And his work has laid the foundation on which the rest of us are building. And I'm so glad that we are able to celebrate him, and even though we can't all be in person together. So now for a few thoughts on the topic of our panel about consumers and financial conglomerates and conflicts of interest. Art has been laser focused on the challenges that financial conglomerates pose for society. And while that's an issue that appears first and foremost in the context of systemic risk, it's also one that has important implications for consumers. So one only has to look at the Wells Fargo scandals in recent years to understand how conglomeration might raise some concerns from a consumer protection standpoint. So when a financial conglomerate is engaged in multiple lines of business, there's a pretty natural tendency to want to cross-sell products, right? That cross-selling reduces the cost of customer acquisition. It just makes sense from a business standpoint. The problem, though, is that cross-selling creates some antitrust concerns regarding bundling and tying arrangements. Right? It might be we'll give you one product will be a loss leader to get you into the one that's more profitable or something like that. And as we saw with Wells Fargo, cross-selling can interact with incentive compensation arrangements to encourage just outright fraud. Now, Wells Fargo, unfortunately, is not an exception. We've seen conflicts of interest arising from the very beginnings of financial conglomeration, even before Graham Leach Bliley. So in the late 1990s, before, a couple years before Graham Leach Bliley, the OCC issued some opinion letters, and I think these were all Julie Williams specials. And they said that a national bank could have a captive reinsurance company affiliate. Okay, and of course the Office of Thrift Supervision, had to keep up, and it issued similar letters. So what happened? Well, banks and thrifts would make mortgage loans, and they would often make them at over 80% debt to loan to value ratio. That meant that Fannie Mae and Freddie Mac would not be willing to buy them unless there was private mortgage insurance on the loans. So the consumer has to go and buy private mortgage insurance. How does the consumer choose? Consumers don't care who their private mortgage insurer is because the consumer is not the loss payee. The consumer is buying insurance for the mortgagee. And all of the private mortgage insurers charge exactly the same rates. There aren't that many of them, and their rate schedules are absolutely identical. So the consumer is going to go with the insurer that's recommended by the bank. The bank, the mortgage lender says, hey, here's the one we recommend. You need private mortgage insurance. Here's a company we recommend. Maybe here's even the name of an agent, right? And how's the bank going to decide who to recommend? Well, the bank is going to recommend the private mortgage insurer that cedes the most reinsurance to its captive reinsurance affiliate. And notice what's happened here now. The consumer is paying more. Consumers paying for private mortgage insurance. And that's supposed to be shifting risk away from the bank. But the risk is migrated right back to the bank's affiliate. And the catch is that the captive reinsurance affiliate is going to be incorporated most likely in Vermont. And Vermont, at least at the time, had extremely lax regulatory capital requirements. So the bank has gotten a break on its regulatory capital, and the consumer is paying more. consumers pay more, and we have less safety and soundness. And all of this circles back to our present moment. The litigation that started the whole CFPB constitutional saga that was the PHH case. That was kind of round one. And that was a suit alleging that the ceding of the reinsurance by a private mortgage insurer, PHH, to an affiliate of the lender was an illegal kickback under the Real Estate Settlement Procedures Act. Notably, with all that litigation, no one was arguing about whether there was a kickback, right? That was never really being challenged. What's notable, though, is that as the financial industry has conglomerated, regulation hasn't kept pace on the problems, on having the tools to directly address the problems that arise from conglomeration. We don't have a general anti-kickback statute or a general anti-steering tool equivalent to RESPA. Perhaps, and I think it can, I think UDAP is capable of encompassing that behavior, but that's not really how UDAP is set up to work. And I think it will raise some challenges for the CFPB going forward if UDAP is the tool it wants to use. Now, legal minds like Kress and Raul, I think we'll find solutions there, but it certainly opens the door to some challenges. Okay, so that's all that said. I've got to say, I think conglomerates are actually, on the whole, kind of a mixed bag for consumers. They absolutely pose some risks of anti-competitive behavior, especially in the context of the platform economy, and Raul in particular is going to get into that. And there's no question that conglomeration and concentration has reduced choices for consumers. Yet we still do have substantial choice in most consumer financial products markets, and our choices might actually be better because of conglomeration. And I know what I'm saying might be a little heretical with this audience. For example, it's nice to be able to have a nationwide branch network for your bank, right? And network effects benefit consumers in certain ways. And bigger banks are able to do things technologically that smaller ones can't. What's not clear to me, though, is at what point these size benefits attach and detach. So I'm not sure, for example, if Chase's growth post-2008 has had any consumer benefits. But pre-2008, maybe some of that growth was beneficial. Similarly, conglomeration might, there are benefits from being able to do things in scale, but then we get the flip side. When you have things being done in scale, you lose the personal touch. And whatever personal relationships consumers might once have had with their financial institutions, those have been all but sundered. And technology is only going to amplify this. So adding on to that, our conglomerates are publicly owned. And that means there's going to be shareholder pressure on management to eke out every last dollar of profit. And that's going to set the stage for abusive practices. Smaller family-held banks, maybe they don't face those pressures, right? But there are trade-offs. They can't always offer what the big banks can. So let me wrap up here and then hand it over to Raul and Kress. The problem that I think we're facing now is that the nature of conflicts and interactions are changing as in banking, as we move from banking as a traditional service to platform-based services. And when we have platforms that offer both search functions and their own products that may compete with third parties, we're going to have difficulties. It's a different kind of conglomeration. It's not the traditional banking plus insurance plus securities conglomerate. It's the search plus product conglomerate, or the product and data aggregation conglomerate. So Raul's going to talk about the conflicts that arise in the platform context generally. And then Kress is going to speak to a specific application, namely online payday lending. I'm looking forward to hearing what they have to say, but I would just throw it out there that I think conglomeration is posing a set of challenges for consumer protection, and we have to figure out what's the best set of tools for addressing it. Is it banking regulation? Is it antitrust tools? Is it privacy tools? Or do we need to come up with a new set of tools? I'm not sure what the answer is, but I think we need to recognize that the nature of the problem is shifting, and that it's better to try and get ahead of this than play catch up. Raul, take it away.
Thanks, Professor Levitin. I think that's a great jumping off point for us. And I hope to get to your question of conglomeration and public versus private power by the end of all this. I think that's really where it's at. I'm grateful to be here with so many friends. As a junior scholar, I've had my entire banking law education shaped by art. I don't remember a time before Wilmarth, so to speak. In September of last year, I had the opportunity to testify before Congress alongside Art regarding fintech and banking charters. I was also on the panel with Professor Gerding and Professor Johnson and Brian Brooks in April that's been discussed. So that's the context for my remarks as well as my relationship with Art. Today, I will try to pick up on a few common themes from Taming the Megabanks, and then we can hopefully have a discussion amongst the three of us about financial governance, privacy, and scale in public and private power, as you were mentioning, Professor Levitin. So I'm going to divide my presentation up in the interest of time just to three quick topics: what's old, what's new, and what are we going to do when it comes to data collection and governance in this space. So when we look at this from the FinReg side specifically, I think a lot of things seem old or the same. In terms of financial design, especially at the product level, there's a lot of innovation theater. Firms will argue that the design of their products or even their general business model helps with access to credit, inclusion, security, stability. You know, in the words of David Marcus from the DM Project, the maintenance of the values that drive the Western world, et cetera. I think Taming the Megabanks makes clear that this is not new. FinTech and TechFins made similar arguments. You know, they're making similar arguments as the first companies to use telegraph, telephone, computer, the internet for finance. Now we have distributed ledger technology and machine learning, et cetera. But I think Art's work really shows that stability, both for consumers and for firms, and at the systems level, ultimately lies in legal design, not technological design, and that a lot of this can wind up serving as a smokescreen. But there is a lot that's new, and Professor Levitin's remarks got to that point, and that's really platform data collection power. I would argue that there's a consensus, at least among progressive privacy scholars, that there are no federal privacy laws or state laws in existence that are properly attuned to mass surveillance, which is perpetual, preemptive, and predictive in ways that surveillance of finances was not, you know, even 10 to 15 years ago. And this occurs at the payments level, the credit level, the investment level, et cetera. And it's perpetuated by really public-private partnership between Silicon Valley, Wall Street, and federal law enforcement. I want to pick up a little bit on Professor Johnson's skepticism regarding financial inclusion in this space, because that's usually the sort of lead argument. In my experience on the ground, too often this new tech yields predatory inclusion. Companies will offer specific services to certain classes of users, say unbanked immigrants, but on terms that ultimately undermine long-term benefits. We've heard how alt data can be used to enable price discrimination, steering, and digital redlining, while making it extremely difficult to know what exactly an algorithm is doing and shielding violators of the COA or the FHA from claims of disparate impact, for example. I want to add a complementary piece to this and say that when you consider public law and data governance more broadly, a lot of these products start to look necessarily predatory. This is especially true on the criminal law side because the government currently deputizes all financial institutions as cops on the beat. AML, CFT, and sanctions law require the filing of SARs, suspicious activity reports, that are relevant to any possible violation of law or regulation. Our libertarian friends will tell you that this overburdens firms. I'm more concerned from the perspective of racial justice and democracy. Today, given some things that changed after 9/11, but also again, the technology involved, SARs eventually make their way to government platforms, to fusion centers, where Peter Thiel's Palantir aggregates the fusion center data. Excuse me, just 1 second, here at my mother's house.
Wish I could train my dog to bark when it hears Peter Thiel's name.
Apologies. So today, most of this information is not even helpful in stopping crimes. Again, Peter Thiel's Palantir, it aggregates the information and then it shares it all across federal law enforcement. There's no Fourth Amendment protections here. You all might recall from Miller that the government decided that if you share records with a private business, then they're essentially public and you lose most of your constitutional protections. And this really matters when that data is used to, for instance, help catch a BLM protester or do something like that. So I'm especially concerned when we're talking about products that are aimed at communities that have very little privacy right now to begin with. And that's not just on the criminal law front. As Professor Chiara Bridges says, the poor already have very few privacy rights at all. Information is collected by DHS, by the NSA, by CPS, by a large array of public benefit agencies. And so we really, I think, need to step back for the themes of the panel. We've been talking about the separation of banking and commerce. Many people want to expand that paradigm. I agree. Professor Allen mentioned a separation between finance and commerce. I think also on the table should be separation between finance and communications, and specifically under that umbrella between platforms and payments. I'm very concerned about tech fins, perhaps even more so than fintechs. As Art has highlighted, big tech will never be satisfied, I think, with a toehold acquisition in the financial services space, even if we close the ILC loophole and fix a great number of these other things, because they want the payments data. The payments data allows platforms to more easily engage in predatory pricing, self-deal, spy on users, rivals, annex adjacent markets, and generally accumulate power. Tying and bundling is everywhere in the payments space. When you think about it online, if you have your own payments product and you're tying that to a purchase, it becomes almost omnipresent. So I get a little frustrated when people say things that, like the Facebook DM proposal, for instance, is just a glorified PayPal, because I really do think the action is on the data space. We know that currency substitution is a tool of power in a political context, and Zuckerberg thinks his company is a government. So again, I find this all very concerning. As far as what we do, Professor Allen brought up antitrust. Sandeep Vaheesan, Lena Khan, Rohit Chopra, many people have argued that the FTC can invoke Section 5 of the FTC Act to engage in more robust rulemaking and enforcement around privacy. The CFPB can do similar things, but we do need some statutory fixes. At the center of banking law, as Professor Wilmarth and Professor Ricks have indicated, we have a recursive definition of a deposit. I'm a big fan of Representative Tlaib's Stable Act, which is aimed at stable coins, but non-deposit deposits more broadly. And on the privacy side, we need a non-recursive definition of a consumer report. I was happy to advise on Senator Brown's Data Act of 2020, as were many others here. I think that's a good first step on that side. Then finally, I'll just note that if we get to a conversation about a public option for digital financial services, which I think might discipline the space more than anything, we do need to have a conversation about privacy. I'm a big fan of Fed accounts and postal banking, but again, we have some experience from privacy law knowing what it looks like when the government offers services to particular communities that I think are in mind in the financial inclusion discussion. Thank you all for your patience with my mother's hounds, but on to Chris, I guess.
Well, thanks, Raul, and thank you so much, Adam, and also especially thanks to Erik Gerding for and the folks at the University of Colorado Law Review for putting this together, and all the tech people at the University of Colorado. It's great to get together for this and be a part of the Festival of Art Wilmarth praise, but I'm going to be a bit of a contrary voice because I, like so many other people throughout the day, feel like I was mentored and encouraged and supported as a young scholar by Art. But apparently I thought I was the only one. He's been doing this to people all over the country. And now I feel a little less special. Now, of course, I'm kidding a little bit, but I just think that that's the real genius of a truly great teacher and a great mentor, to make so many people from so many different perspectives and across so many different disciplines feel like their voice matters and that they count. And I felt that way too. Early on in my career, I intersected with Professor Wilmarth's work when he was writing about the OCC's preemption of state mortgage lending regulation in the run-up to the financial crisis. Most of my work as a scholar has been focused on the consequences for financial products at the margins of our society, fringe products, fringe practices that are oftentimes hurting and harming people on the fringes of our society. And Art, even though he was more of a traditional banking scholar, I'm usually think of myself more as a consumer protection scholar, he got straight to that point because he cared about the implications of banking policy for the people that don't have large retirement accounts, aren't shareholders of major banks, and I celebrate him for that. And it's such an honor to be a part of this conference. So I want to talk just a little bit about a paper that I'm writing, and then maybe speak to a couple of themes that I think resonate in some of Art's work over the years, and then also point in a direction for the future about why I think that Art really, in his work, is going to have a legacy that's going to be relied upon for generations. So this piece I'm working on right now is an empirical piece with Dr. Melody Harvey and Dr. Cliff Robb, both from the University of Wisconsin. And we're using 2018 National Financial Capability Surveys, survey data. It surveys about 26,000 adult Americans, and we're looking at their self-reported use of high-cost alternative financial services products, and in particular, payday loans. And we're looking at correlations between that self-reported payday loan use and also a series of variables that characterize the underlying legal environment for various states across the country. Because as those of you, many of the people here will know, most states have some sort of traditional usury laws in varying degrees. Some set the caps very high. It's often a bit of a patchwork depending on what kind of lender is making the loan, but they don't touch banks very effectively. But there are some states that people in the policy community will characterize as payday freelandia, meaning that high cost triple-digit payday loans are not legal. There's no way to structure around them. And what we found was that even in those states, there are still self-reported payday loan use, but that you can really see three categories of states emerge. The highest use is in states that don't have laws against payday loans at all. A middle category would be in states where there are some laws or fairly good laws against payday loans, but there's minimal public enforcement, meaning that the state attorney general or the state banking regulator is not really pushing up on enforcement actions. And there you see less use than in the non-regulated states. But what you really need to start to make real progress in bringing down high-cost loan use amongst fringe, high-risk borrowers is not only good substantive law, but robust public enforcement. So, and that's not a terribly surprising empirical result, I suppose, although it does fly in the face of what I call the inevitability argument you see dating all the way back to Jeremy Bentham, that there's no point in having usury laws because it's inevitable that the loans will be made. Well, it's not inevitable. It's a little more gray than that. If you have good laws and you have effective public enforcement, you can actually make a big difference in the lives of ordinary working people. Well, what does this have to do with Art Wilmarth, and what does it have to do with conglomerates, conflicts, and an intersection with consumer protection? Well, first off, I think that just like Art pointed to in 2006, 2007, the OCC is again using preemption to facilitate regulatory arbitrage at the state level to facilitate fringe financial products. The OCC's rent-a-bank regulation, something the consumer advocates are calling it the fake lender rule. Senator Brown talked about it and just earlier today. It would make it so even the most minimal connection between a bank and an online payday or high-cost lending company would be sufficient to circumvent wildly popular state usury laws, many of which are enacted by public ballot measures. In the whole history of the American Republic, not one time has the public voted against a traditional state interest rate limitation in Ohio, and it's both red states like mine, purple states and also blue states. They all support traditional interest rate caps because ordinary people know that extremely high cost loans tend to not be very productive for communities. Well, and that's what we see here. And part of the reason I think that it's so, that Art's most recent book is so important is because it's not just about whether or not there's the risk of bailouts, it's the political risk of banks getting so much power that they can exert the political power through either through the administration or through the Congress to clear the field from the important state and local regulation that tries to preserve protection at the community and grassroots level. And then the second thing that I think it points to about, or a theme that my paper is going to draw upon from Art's work, is that there's a conflict of interest, and there are conflicts of interest that come about from size. You know, we often hear our friends that are you know, market oriented talking about the unintended consequences of regulation. Well, obviously that can't happen, but there are also unintended consequences associated with large agglomeration of financial and political power in our society, and looking beyond large banks to some of the technology effects, the platform effects that we're seeing from large technology companies. We're seeing that now in the high cost lending space. Even though Google takes the position that it won't accept advertising from lenders that make loans above 36%, Google's search algorithm has dramatically affected the way that online payday loans are delivered across the country. Why? Well, because consumers that are searching for a term like online or payday loan or some other high cost loan term, signature loan, cannot identify which companies are real companies and which ones are not. And so they very often end up in a rat maze of lead generation companies that take loan applications and then turn around and use a reverse ping tree auction to sell that loan application lead to the highest bidder. And the consequence of that is that it actually drives prices up and decreases costs, or decreases transparency and information available to the consumers. Why? Because the more money you charge those consumers, the more that you can pay in that reverse ping tree auction. And it turns out that the average interest rates in the online payday loan market are higher than they are in the storefront brick and mortar stores, because the actual overhead costs are more significant in the online industry when you don't have a storefront location. Why? Because bidding up those ping tree auctions is more expensive than having a storefront location distributed all across the country. Well, and what does that have to do with art? Well, you know, art's insight about how bringing political power and market power together, creating unintended consequences. That's what we're seeing here with Google, not intentionally facilitating this, but just because there are so many companies that are in the orbit of the way that the Google search algorithms function. We've designed a market where people on the fringe of society are vulnerable to more vulnerable to predatory lending at a time when we had thought that there was so much promise from the internet to solve some of these problems. And I think that that's part of what Art's long-term legacy is going to be. You know, it's not just the fact that he's a wonderful mentor and a teacher and that he was so involved in so many academic debates over the years. It's that he saw clear and important themes that resonate in our commercial patterns that are going to replicate themselves on and on again. His was a leading voice in his time in the grand pageant as we all try to move our society towards efficiency and justice. It's such an honor to be a part of a small part of his celebration today, and I'll be hoping that our paths cross again soon. Thank you so much.
So I think Erik is going to say a few concluding remarks here. I think we have to keep the train moving.
We do have to keep the train moving. Thank you, Adam, Raul, and Chris, for a wonderful panel. This was, I think one of the lessons I get from this is it's a headache to be a regulator with all these issues, but it's a good time to be a young scholar. There's just so much rich issues here. I could take notes all day on what I should be writing about for the next 20 years. Thank you again. I'm going to turn over to our next panel. We are We have one minor issue. Rosa Lastra graciously agreed to serve on the next panel, although she was testifying before a UK parliamentary commission earlier in the day. So she might be joining us a little bit late. But in the meantime, I will get started introducing our panel. Dr. Lastra, who will be joining us late, is the Sir John Lubbock Chair in Banking Law and Chair of the Institute of Banking and Finance Law and the Center for Commercial Law Studies at Queen Mary University of London. If you look at her bio online, there's a very, very long list of governmental bodies in the UK, in Europe, and in the United States to which she acts as advisor. We are also joined by Professor Dr. Gerding, who is director of the Institute of Law and Economics at the University of Hamburg. He is also a visiting professor at the University of Oxford Faculty of Law and is part of the European Corporate Governance Institute. Let me put in a big plug for those of you who are academics. Georg is the co-editor of the Journal of Financial Regulation, and we have him as well as Kate Judge and Dan Alry to thank for bringing peer review, a peer review journal to the legal field of banking law. So if you're writing and interested in submitting to a peer review journal with an esteemed editorial group, that's the place to think about. And our moderator for this panel is Heidi Mandana-Spooner, who is professor of law at the Columbus School of Law at the Catholic University of America. Heidi is a longtime friend of Art, and somewhere in the back, I have her book on international financial regulation, which I use heavily as a reference guide every time I am writing on anything international. So who better to moderate this particular panel? I'll turn it over to you, Heidi.
Erik, thank you so much. I'm just delighted to share this celebration of Art Wilmarth, who for almost 30 years has been my mentor, my role model, and my good friend. And others have shared many of Art's wonderful qualities. And I think there's one that's been missed that's very important, and that is Art's wonderful sense of humor. As many of you know, when Art's humor is directed toward the likes of Citigroup, it can be quite stinging. But when Art's humor is directed toward colleagues, it is simply delightful. And so in this more lighthearted vein, I just want to start with and share one of the most important nuggets of wisdom that Art has shared with me over the years. So if my memory serves correctly, this was advice that I got from him at a particularly raucous conference dinner in New Orleans, I think it was. And Art said to me, I won't bore you with the lead up to it, but Art said to me, Heidi, you've got to give up drinking white wine by the time you're 50. White wine is the evil of middle age. And I think he said that with a scotch in his hand. In any event, of course, given the source, I took his advice to heart. And let me say, Art, that you are the master of separations, and I have benefited from separating white wine from my diet for many years now. So I thank you for that. With regard to this panel, I will keep my introduction brief and hopefully maybe have time for some of my questions at the end. But I want to point out that a comparative analysis, as others have suggested during the day, has always been an important feature of Art's view of megabanks. And in Taming the Megabanks, Art notes, for example, that the UK and Canada did not suffer from a systemic banking crisis the way other countries did during the Great Depression. And yet, in the 86 Big Bang reforms in the UK, when the UK changed its policy of separating banks from securities firms, when that ended, and a few years later, the more formal separation ended in the US, by 2000, universal banks dominated both the US and the UK. And Art concludes that those common elements help to explain why the US and UK suffered so acutely during the 2008 financial crisis. So that's just an example of Art's comparative perspective. This panel is in that general comparative spirit, and Rosa hopefully will join us later. She is going to be talking about comparing and contrasting regulation of conglomerates in the US, UK, and EU, and with perhaps some special comments on the impact of Brexit. Georg, who will begin our discussion, will be discussing ring fencing in the US, in the EU, particularly in Germany, and how the structure of financial conglomerates in Europe impacts their resolvability. So Georg, I'll pass it off to you.
Thank you, Heidi. I'm very honored to be here and to celebrate the work of a really towering figure in financial regulation on both sides of the Atlantic. And let me add this, that, let me assure you that art scholarship is very, very important and well received in Europe as well. And if it needs, one single piece of evidence, look at the book, and there's lots of it on developments in Europe. In particular, my own home country, Germany, features very prominently, both historically and contemporary issues in the book. And it's a great pleasure to contribute a little bit on that theme to the topic here today. So the theme of the book, as well as lots of panels here in the conference, is on universal banks. And I can assure you that we do have a long tradition and experience with universal banks in Europe, in particular in Germany. We have this very long-standing and cozy relationship between banks and firms that they finance. In Germany, it's known as the Hausbank model, Hausbankmodell. So basically a universal banking group that provides the whole range of financial services to the firm, ranging from traditional loan services, but covering the whole securities markets and investment services, plus traditionally also holding an equity stake in the firm. So it's a very strong link between banks and industrial companies through cross-ownership stakes, extensive bank loans, and large corporate deposits. And it's no secret that Hausbank model is something that was and still is probably deeply ingrained into the German financial system, and somehow also something that politicians haven't really been challenging for many decades. Germany is a very bank-centered financial system. Europe, continental Europe in particular, is a very bank-centered financial system in comparison to the more capital-oriented situation in the US, as we know. So this is an important pillar of the financing of the German economy. And of course, it came under threat, as we all know, right? It came under threat in two ways. One is the EU agenda. So the European Union has been pushing for more cross-border financial services to be performed, more cross-border integration of banking services, and more recently also for the development of stronger capital markets to take the place of just relying on the banks. And the second threat to the cozy universal banking system is obviously the global financial crisis, as if it needed another piece of evidence here, that it became clear there are these risky spillovers in particular resulting from the powerful banking group, in particular the investment banking services. And so it was in the spirit of that time, if we wind back a couple of years, the attempts of ring fencing, which were mushrooming up everywhere in the world and also didn't stop in Europe. And I think this ring fencing policies that we saw in the making at the time is a really interesting case study on the politics of the European Union, because, and this is maybe not something that everybody knows here in the audience, we do have a version of ring fencing in Europe. It's named after the chair of the working group looking into this, Liikanen, Arki Liikanen, former governor of the Bank of Finland, made a number of important proposals in 2012, following international trends like the Volcker rule like the British Vickers Commission, the Independent Commission on Banking, and so wanted to roll out the same idea of separating different parts of banking into different ring-fenced entities. And what's really interesting then is the response in Germany they received in Germany, because the German government wasn't super keen, I think that's fair to say, on those proposals. They quickly acted on the national level rather than supporting activities on the EU level. There is a German ring fencing act that was adopted quickly after the first proposals on the EU level in 2013. And that was sort of to act as a first mover advantage, right? So it was basically the reason to say, look, Europe, we already have something at the national level. You in the European Union, you don't need to add anything on top. You know? And so the EU proposals to introduce a common rule on ring fencing Europe-wide completely failed in the end. It was impossible to secure an agreement between the European Parliament and national governments, and Germany and other countries, it was not just only Germany, it was other countries as well, were successful ultimately in delaying EU activity as long as they could. Certainly also lobbying efforts of big banking groups in the making. So in the end, the EU attempt of regulating the thing didn't come to anything. And all we have now is a German ring fencing act, which is really an extremely watered down ring fencing act, which was clearly motivated, by the idea of giving domestic banks a competitive edge. Don't forget, this was the time of the European sovereign debt crisis as well, when there was already a fear of being, overly restrictive in regulating banks. They were seen as being crucial for keeping the economy running. And in the end, we do have a prohibition on, proprietary trading, similar to the Volcker rule, unless it's in a separate entity. But there are high thresholds before it applies, and it doesn't even apply to activities that is commissioned by the client. So really, it's a very limited scope, and I would see it as largely a symbolic act that was designed to fend off any more stringent action that was taken at the EU, that was to be taken at the EU level. Let me conclude those introductory comments with one issue that Heidi has mentioned. I think the ring fencing theme that has been subject of the debate here today has also important repercussions on the resolvability of banks, right? And we know that these universal banking structures, these house bank ideas, make resolution very difficult. And if you look at the structure, if you look at the entity chart of big European banks, they're very different from their American counterparties. We don't have the holding company model, which makes it very difficult to effectively implement something like single point of entry resolution. There is now an encouragement to nudge or to encourage European banks to reorganize, to restructure a little bit towards such a holding company model to make resolvability more of a realistic prospect. And the European Banking Union, which is really trying to place banking supervision, banking resolution into the European hands rather than into the national hands, is something in the making. We have made some good progress in that field, but that again remains ultimately an incomplete journey. Why don't I stop there and hand it over to Rosa, who I just seen has now joined us. Thank you.
Thank you, Georg. Rosa, take it away.
Thank you, and it's always a pleasure to share the podium with Georg and Heidi. Nice to see you online. I'm missing the opportunity to see you all in person, but this is the new world of Zoom land, and we have become almost too used to it, if I may say so. It has an advantage, of course. It allows us to do these cross-Atlantic events on a day in which maybe many of us had also other commitments, before in the past, you just had to go, which in a way is better because you just focus on the conference. I couldn't say no, and I apologize, I joined later, but both Erik and Jeremy knew that when I accepted the invitation today was a day in which I had a pre-commitment, but I couldn't say no to art because before I speak, let me just say a couple of minutes about art. Wilmarth and his enormous contribution, not only to the literature, but to scholarship by having been a mentor and a maestro and a professor to many scholars in the US and to some others like me, even if it was not a direct maestro, someone that has influenced very much my thinking on regulatory issues and my thinking on banking issues. And his book, Taming the Megabanks, is a wonderful book. I like it so much that I hold a London financial regulation seminar. And earlier this year, he made a wonderful presentation in which he focused on why we need a new Glass-Steagall. And I have been, in the aftermath of the global financial crisis, I have been following, like all of us, with sometimes exhaustion, because the amount of proposals keep on increasing at all levels, whether it's soft law, US law, European law, national law. But I mean, some of the problems are quite basic, isn't it? And so some of the problems have been with us for a long period of time. You know, how do you organize big banks? How do you tackle the too big to fail? How do you deal with the separation of securities and banking? And I recall a conversation I had, like so many of us have had, very insightful conversations that spark a new thinking with Art about this separation between not just banking and securities or banking and insurance, but also between banking and commerce. And I remember that when I was at the IMF at the beginning of my career before I went into academia, one of the issues at that time is what model of banking is better to foster diversified sources of funding for the new enterprises. And we're talking about the beginning of the 1990s with the breakup of the Soviet Union. And obviously there were this, what Georg has now explained, the universal banking model, which is a model which variants in Sweden, France, Spain, has been the model that has been predominant in continental Europe, and the model that has been predominant in the EU, in which it has led to a very undiversified financial market. We have had, of course, in the last 20 years, mostly through efforts spurred by the European Union, in increasing proposals to develop a capital markets union and to develop a better framework for securities. But it is true that we have had, and we continue to have, bank-dominated banking systems in Europe. And indeed, our latest development, which is banking union, it focuses on banking. So that was actually my first point today. So how do we deal with the test of significance, which is a major issue in both structural reforms as well as dealing with financial conglomerates across the two sides of the Atlantic? And we deal it in different ways, because in Europe, we have focused our test of significance in banks. So we have not really established a proper test of significance when it comes to supervision outside banking. So the banking union these days separates the supervision of significant and less significant entities, with the ECB doing the supervision of the significant institutions according to the single supervisory mechanism regulation, and the national competent authorities doing the supervision of the less significant entities. But it focuses around banks. The test of significance focuses around banks. Then, of course, when we look at the US, the test of significance has been very different, because the test of significance, Dodd-Frank allowed FSOC, which is much more broader in terms of interagency composition and a certain politicization, by having the Secretary of the Treasury at the helm of this new super committee, design and designate, and I'm not going to go into all the problems of designation, which some of you have done, extensive and good literature, but I'm just talking about the concept. So the concept of significance is quite different. In the EU, we have continued with our bank-dominated and done test of significance for banking groups, which are supervised by the ECB. And it is true, we have an arrangement, for investment firms and for the resolution of cross-border groups, but we're still bank-dominated when it comes to our latest effort. And that, of course, has, and again, I can only second what Georg just said in terms of resolution. It has led to very different structures and proposal with regard to the single point of entry or multiple point of entry. So that with regard to the test of significance. But let me go back to the conversation I had with Art, about the advantages of having a separation between banking and capital markets, the separation between banking also and commerce. And one interesting dimension in the structural reforms is again the very different ways in which we're doing structural reforms. Georg again referred to the Likani proposals, which is somehow a way of tackling within the European Union structural reforms. But the one thing which we have is in the UK. In the UK, we adopted the ring fencing approach. And as everyone knows, the ring fence approach is centered on a list of activities which are called core activities, and only ring fence banks will be able to achieve core activities. So this is, of course, following the implementation of a report that was under the name of Vickers, the Vickers report, and now has become a legislation through the Financial Services Banking Reform Act, which is also now part of the FISMA. So what are the core activities in the UK? In the UK, the core activities include, obviously, accepting deposits, other activities designated by Treasury when an interruption of the provision of services in the UK could adversely affect the stability of the financial system or a part of it, and the continuity of the provision of those services can be more effectively protected by treating the activity as a core activity. So ring fencing means that the following institutions are actually exempted by the definition of the ring fence body provisions of the FISMA. So insurance companies, and then cooperative companies, Northern Ireland credit unions, Northern Ireland industrial and provident societies, and banks which hold less than 25 billion core deposits, as well as bodies which have only been ring fence bodies as a result of action being taken under the Banking Act 2009 to stabilize a banking financial difficulty as part of the resolution mechanisms in the UK. So again, as you can see, a different approach, because the UK ring fence approach is sui generis, it has not really been followed. It's kind of in between. When the UK was looking into implementing this legislation, it actually invited to give evidence to Paul Volcker. And Paul Volcker was, like Art, a proponent that some return to Glass-Steagall of some form. After all, the Volcker rule was a minimized version of that, was probably a good way to tackle the element of size and complexity which we have now in the modern dimension of financial conglomerates. So again, very different solutions, in the UK, in the US. Well, I'm talking here to the experts, but you have the bank holding company as the structure that has really provided like an intellectual framework to the whole discussion of banking regulation, and then of course financial holding company. So here again we have a different element of different understanding. And conscious of time, the last element I will mention that I think is quite different is actually what is a group, what is a conglomerate. And again, here we don't have a common definition. So in the EU, as again, Georg and you, Heidi, know well, we have this Financial Conglomerates Directive. And then at the same time, we have a proliferation of different lists of SIFIs and GSIFs and the whole family of what is domestically systemic banks, globally systemic banks, systemic and important financial institutions, systemically important insurance. But again, my point is that I very much sympathize with Art's arguments. I very much sympathize with the idea of having diversified sources of capital and not to have implicit government protection. But my last point, which in a way builds up with the others, is that not just across the Atlantic, even in Europe, we have very different solutions and very different denominations. And again, so what is a financial conglomerate or banking group, or financial or non-financial group, has now acquired a whole new dimension under the lens of what is systemic risk, systemically significant. And so we had from previously the whole bank holding company structure, German universal banking, the Financial Conglomerates Directive, and then now we have superposed on that a new kind of denomination that looks not through the lens of structural reforms, but through the lens of systemic risk, understood the test of significance very different across the Atlantic. So we have, after the crisis, we have an even more divergent structure. And I have a student, Marcelo Shepard, is finishing his PhD, and he's comparing this, what is exactly a banking group? What is exactly a financial conglomerate? And it is quite remarkable to look at the regulatory divergence that we have on such an important issue, that clearly Art artfully, if I may use the word, manages in his book, but that brings us all together tonight. So I think I've said enough, and thank you very much, Heidi and Georg, for being together with me in the panel.
Thank you, Rosa. So we and Georg, I learned so much from both of your work over the years and from these comments. We only have a few minutes left, so I'm just going to pose one question to the two of you to sort of look forward a bit, but begin by looking back to one of the first articles I read as a new academic. Was an article that Art wrote about the dual banking system in the United States. And thinking back to that article, it reminds me that, and sort of Rosa's comments about the banking union efforts in Europe and in the UK, that the US tried to create a banking union almost 150 years ago when Congress passed the National Bank Act. And yet that remains very much a work in progress in the United States. And maybe it's because, as Rosa mentioned, in the United States, we have so many other aspects to the industry that we focus on. But I would say, in fact, with regard to that project, the earlier panels talking about financial technology, the tension that creates, given that banking union project is still unfinished, have been brought into sharp relief as we see federal and state authorities fighting over their turf, et cetera. So I would ask both Georg and Rosa. So first, Georg, do you have thoughts on the growing pains in the EU's banking union? Any important aspect of the ECB project that you think remains outstanding with regard to conglomerates? And then Rosa, if you have any thoughts about aspects of the pre-Brexit financial conglomerate scenario of regulation and supervision that will be most difficult to change or maybe most important to retain. So I'll leave the last words to you, starting with Georg.
Thank you, Heidi, for this question. That's a really interesting, fascinating point to compare this to the US emergence of the banking union. Well, I think in many ways, yes, there is some similarity, but the banking union in Europe is an attempt to overcome of the deficiencies that I pointed out earlier, right? It was remember the sovereign debt crisis of the years 2010 to 2012, where there were these very strong links between national governments and national banks, and it was felt that we need to have an unbiased supervisor at the European level and an unbiased resolution authority to take a much more European-wide approach and not overcoming any national forbearance over banking supervision, banking resolution. And to be fair, I think a lot has been achieved. If the crisis is big enough, then you can see unexpected things. Nobody would have expected this to happen, but in these years, 2012 to 2014, the pressure was really big, and so people agreed. And the Eurozone, it was not the UK, it was actually, from the beginning, it was always a Eurozone project, excluding the non-Euro EU countries. But we do have a common supervision now for large banks. We have a common resolution authority for large banks. We are missing still the third element, which is the common deposit insurance mechanism, which arguably is an important third pillar of it. But we are some way towards achieving it. We're still missing, I think, the common safe asset ultimately. Because time is flying, I just limit myself to these points. I think some progress has been made, but we probably need another big crisis for achieving the rest of it.
Rosa, your turn.
Yes, thank you very much. So, with regard to Brexit and post-Brexit, it was amazing that it was the only game in town until COVID, and now no one talks about Brexit in this country. all the conversations.
Yes.
But in part it's because hardly anyone is traveling, so hardly anyone is realizing that we have lost the free movement. Well, I haven't personally because I have UK nationality these days, but also I have kept, of course, my Spanish nationality, which, I feel, deep core, very Spanish. But as everyone knows, the transition period in terms of the legal adoption of the instruments of EU law and your UK law ended at 11 p.m. on the 31st of December 2020, and the UK's onshore, that's the name they have used, the new legislation, onshoring. So onshoring was the process of amending the EU legislation and regulatory requirements so that they can work only in the UK context. I always tell my students it's like doing Control-Alt-Delete. So Control-Alt-Delete, all EU law becomes UK law. They have chosen the name, not Control-Alt-Delete, but onshoring. But of course, once that onshoring takes place, from that moment, everything starts changing in the sense that there can be new interpretation of rules, there can be new requirements, new implementation of capital or other things. And also, obviously, in the issue that we're discussing today, when it comes to financial conglomerates, to ring fencing, to structural reforms, the UK, to be honest, I don't know where it will go, but it is likely to go a different way because it wants to make the City of London post-Brexit an attractive place. They had talked in the past about these Singaporean themes, like, kind of offshore type of jurisdiction, low in tax that could attract business. I don't think that is feasible, but it is clear that the UK government is working on different ways of making the post-Brexit world more attractive for financial services so that the City of London doesn't lose the prime position that it has had. But it's not easy because it's still, one of the largest markets, and we've seen news with derivatives and equities and Amsterdam and Paris and this and that. I mean, the truth is that, it is really work in progress, and the government hasn't really come with a clear plan of what it exactly that is going to do. But the loss of, obviously, of cross-border financial passport, which allow the UK banks and other financial entities to provide and offer their services across Europe, has already led to a lot of structural reforms, obviously, ahead of the Brexit. And also in the aftermath of Brexit, banks had to reorganize themselves and to decide whether they wanted to operate via subsidiaries and then through their subsidiaries branch out to other things, or whether they wanted some sort of holding company, or sometimes revert back to the US if they didn't think that doing business, in the UK was attractive. So the truth is that all the EU law is part of UK's law still, because we're only a few months. They will begin to diverge. So this picture I was presenting of divergence, and this will obviously affect also the EU probably will want, once that the COVID agenda ceases, will probably want to go to a more sort of capital markets union, and then it needs to decide what type of legal arrangement it wants to do, because capital markets union was very much of a UK-led type of reform. So it was many of the law firms in the city that were actually quite excited about the opportunities that some of the issues that go into this bracket of capital markets union could happen. But it's, I foresee a divergence in not just because of the interpretation by the Court of Justice in the case of the EU, and here the National Court of Justice, which was a very big element of sovereignty. So I think, that I don't have a crystal ball to gaze into the future, but clearly the UK government at the moment is taking very seriously the opportunity to make London and the UK a center of green finance and digital finance, and those things, are a priority over any other issue of structural reform. So as everyone knows, the Chancellor has now come up with a proposal for looking into a digital pound and just, trying to do that, which actually leads me to think to an issue to reflect that it touches upon, again, one of our concerns, which goes back to, in a way, competition, antitrust, and excessive concentration of power in the hands of a corporate entity. And that is the issue of these financial digital conglomerates. So not only not only they're financial in nature, including Apple and Facebook and Amazon and all the others, but they are also, you know, in the digital world, they're they're conglomerates in the digital sense. So they're massive, talking about taming the megabanks, these are the mega finance digital kind of conglomerates. And I think we need to move, as I said, because I couldn't attend early, maybe this was discussed, but we need to move the agenda of art of taming the mega banks, taming also these, you know, financial digital conglomerates using traditional tools of regulation and antitrust, you know, and
I think earlier panel, Hillary Allen called them the tech fins, not the fintechs, but the tech fins.
That's good.
So I'm sorry to cut you off, Rosa, but I think we're out of time.
That's enough.
Thank you so much to Rosa and Georg for a great panel. I really appreciate it. And thank you, Erik. And hello to Art.
Thank you, Art. Thank you very much.
Thank you to that last panel. Herzlichen Dank, muchas gracias. It's very late, 9:30 in Hamburg and 8:30 in London. So I really appreciate you staying with us, particularly after a busy day. Unfortunately, we have to keep moving on. We have so many great panels. Our next panel, one of the things that we were thinking about in designing this conference is really highlighting the different generations of scholars who really have taken up the mantle of Art's work, and the different generations who've been influenced by Art. And these next three panelists are all must-read authors. First, we have Jeremy Kress. If you're wondering, that is the same Jeremy Kress that you saw at 9 a.m. Eastern. He is still with us. He's an assistant professor at the University of Michigan Ross School of Business. He is a former attorney at the Federal Reserve Board, and he is the co-director of Michigan's Center on Finance, Law, and Policy. He's joined by another rising star. I shouldn't say rising star because both of these individuals probably have better records of scholarship than I do. Lev Menand is a fellow at Columbia Law School. He had an extensive stint working at the U.S. Department of Treasury, including advising the Deputy Secretary of the Treasury. Lev has also worked at the New York Fed. And our moderator is Jennifer Taub, a professor at Western New England University School of Law. She is one of the nation's foremost experts on white-collar crime. In fact, she has co-written the book about it. She also has an excellent book on the subprime mortgage crisis called Other People's Houses. So I will now turn it over to Jennifer.
Sorry, I'm muted. Yep. Thank you so much, Erik. I have to say, because my publisher would kill me, although I did co-author a case book on white-collar crime, I have a new book on white-collar crime out with Viking Press called Big Dirty Money, and I encourage you all to run out and buy it right away. So I want to begin by letting you know what our roadmap is for this panel, and then brief tribute before that to Art. So the title of our panel is Supervision and Governance of Conglomerates. So we are going to neatly divide the topic. Jeremy will begin with a discussion of governance, and then Lev will talk about supervision. So you might wonder, given my background on white-collar crime, who am I? And why am I here? Some of you are too young, like this panel is probably too young to remember the debates with Admiral Stockdale. Does that ring a bell with you two, or no? It does, okay, a little bit. Yeah, so who am I and why am I here? We're 6.5 hours into this conference. And most of us, I think, care. Why do we care? Why are we here? Because of Art. There's that. And like all of you, he welcomed me, especially someone like me who has never worked at a prestigious law school, who chooses my locations based on where I want to live, who chooses what I want to do based on what happens to interest me at the moment. I've had a very non-traditional career, spent a lot of time at Fidelity Investments, and not for a minute when I started talking about writing a book on the financial crisis and got very interested in Art's work, did he question my credentials? Did he do anything but encourage me? And I am grateful for that. He is a tremendous role model. So I know that we care and we're here because of Art. But I want to ask the question that was a bit raised by Lisa Fairfax earlier, which is, what is the problem? I mean, she raised this, she didn't ask it as a question, but Lisa did pose it as, we don't all agree on what the problem is. And so to some degree, I think the reason why we care about regulating megabanks, most of us, is about the safety and soundness of the banks and also systemic risk. In other words, we care about failure and the damage caused by failure. And to quote Ben Bernanke after the 2008 crash, the problem is when the elephants fall down, all the grass gets crushed as well. So that's usually our framework. But I think we also understand, and as Kress alluded to, we also care about these conglomerates, even when there's not a crisis, because to some degree, drawing from our friends in antitrust, we care about size because size confers outsized advantages. And in my world, I care about the conglomerates because tremendous power, as Art said with Lloyd Acton, I agree, power corrupts, absolutely. And I believe wealth and power combined together is a criminogenic environment. And so what I think is important, and I will wrap this up, is that we should think, and this is tying into Kate Judge's comment, that we should all think about this topic, this so-called private topic, as public law. And when I think of public law, I think also of white collar crime. And so when we talk about governance, which is to some sense self-regulation, internal governance, corporate governance, or we talk about supervision, we're usually not talking about criminal law, right? We're talking about ways to coax enterprises, entities, conglomerates into abiding by the rules that everyone else has to supposedly live by. But all of that push, all of that is up against tremendously high personal incentives from the people who make the decisions inside of firms, either at the top or even at the trading floor, that are just so much richer. The incentives are so much richer than the slap on the wrist that they might get. And so this is where I believe failure to enforce criminal laws against leaders of conglomerates engaging in behavior for which they may settle with the SEC or settle with a banking regulator. I have numbers of examples, but never get into any criminal enforcement, means that we cannot actually tame the megabanks. So in brief, as I would wrap this up, I would say, Art's talking about, and I still firmly believe in, this idea of separation of activities, of deposit taking from underwriting and broker dealers. And of course, Dan's here, so I should say insurance as well. I believe in the separation of those businesses, what we would say, break them up. But I also believe if you can't break them up, maybe you're going to have to lock them up. And with that, let me hand it over to Jeremy.
Thank you, Jennifer, and thank you, Erik, for organizing today. And I just want to take a moment to say thank you to Art for being such a tremendous role model, as Jennifer said. Art, you're a role model for me in two respects. One is your generosity of spirit. I think anybody who has ever sent a draft to Art for his comment knows the feeling of getting back not only comments, but a treatise, an annotated treatise from Art with pin sites and his observations on the draft. And that's the case, even if, perhaps especially if he disagrees with you. Art and I generally row the boat in the same direction, but there have been the rare instances on which we don't see eye to eye on issues, and he has no doubt helped refine my thinking and strengthen my thinking on those issues. So my work is stronger for your input, Art, no doubt, not to mention being incredibly informed by your work and motivated by it. Art, the second way in which you're a role model to me, and I think to a lot of junior scholars, is your engagement with public policy makers. Art in his work does not talk only to other legal academics, but he talks directly to policymakers, and it's been that way for decades. I understand that's not necessarily how legal scholarship was always done. But I think, Art, the way in which you've influenced public policy debates is something that I strive to emulate in my work. So thank you for that. I want to talk today about one area in which Art has really influenced my thinking, and that is governance of large financial institutions. Right? Art has said in his work that governance of financial companies is really hard for a lot of reasons. Financial companies are opaque, right? It's hard for stakeholders to know what is going on within a financial institution. Art says that governance of financial companies is difficult because they're very fast moving. Right? They're leveraged and they rely on runnable forms of funding. Art says that governance of financial companies is difficult because they suffer from moral hazard, right? The types of market discipline that we would expect from creditors in ordinary companies really isn't there with financial companies. So we've taken some steps to try to regulate the governance of financial companies, to try to better align the governance of financial companies with public policy objectives like financial stability. So as Lev will no doubt talk about, financial companies are subject to a bunch of supervisory and legal requirements to oversee operational and compliance and legal risks. But I think Art's real contribution is noting how much more difficult governance is at very large financial conglomerates compared to ordinary financial companies, right? All the problems that I mentioned before, the opacity, the riskiness or the runnability of the funding and the moral hazard problems, those are all exacerbated when financial companies become very large. The too big to fail subsidy gets larger. The challenge of supervising or managing a $4 trillion institution is much bigger than managing even a $100 billion institution. So, those are all the reasons why Art says we have a too big to manage problem, and I tend to agree with him, and leads me to believe that Art is right when he says that we should think about breaking up these firms if they're too big to manage. So I want to mention in my time today 2 projects related to governance that have been very much informed by Art's work. The first is a piece I wrote several years ago called Solving Banking's Too Big to Manage Problem. This piece starts from the observation that back in 1999, when Congress passed Gramm-Leach-Bliley and repealed Glass-Steagall's affiliation provisions, Congress created this new class of institutions called financial holding companies, or FHCs, that would now be able to engage simultaneously in commercial banking, along with investment banking and insurance. But when Congress did that in Gramm-Leach-Bliley, it didn't authorize all bank holding companies to become financial holding companies. Congress said, in order to become and remain an FHC, the depository institution subsidiaries had to be and remain well capitalized and well managed. That well managed requirement was tied to the bank's Campbell's rating, basically 1 or a 2 on a 5-point scale, counted as well managed. This was one instance of Art helpfully pointing out a really important piece. Congress then doubled down on that requirement in Dodd-Frank. It used to be that only the bank subsidiary had to be well capitalized and well managed. In 2010, Congress added the additional requirement that the holding company had to be well capitalized or well managed. So in 2010, Congress said, no, we really mean it, guys. We only want strong, well-capitalized firms to be able to engage in these very risky financial activities. The problem is that the Fed doesn't enforce this requirement, right? We know based on aggregate supervisory data that the Fed has released that 40% of large financial holding companies with more than $100 billion in assets don't meet that well-managed requirement. They're not rated 1 or 2 on the CAMELS or the RFI or LFI rating scale. And yet the Federal Reserve has never publicly revoked a financial holding company's FHC status. I think that's a problem, right? Whether or not we enact Glass-Steagall, the fact of the matter remains that we're not even enforcing the law as it stands on the books. Okay? So there may be good reasons to reenact Glass-Steagall structural separations. What I claim in this piece is, at a minimum, we need to enforce the law as written and ensure that only well-managed FHCs have that privilege to engage in expanded activities. The second project I want to talk briefly about is a work in progress that is very much motivated by Art's work. It occurs to me that Art is often recognized as a bank critic. I think that's not true. I think Art is actually a defender of the banks. What Art is critical of is banks, non-bank affiliates taking advantage of the depository institution subsidiaries, right? The implicit or explicit government guarantee that comes from having a depository institution within a broader financial conglomerate. So this piece that I'm working on is very much motivated by Art's internal Glass-Steagall proposal and the ring fencing discussion that Georg and Rosa were having earlier and that Paul Tucker mentioned this morning. I think we can fix some of the problems of depository institutions being taken advantage of by their affiliates with a simple governance fix. I actually went back and I checked. The top 20 or 25 conglomerates in the US, their bank boards, the boards of directors of their depository institutions, overlap almost entirely with the holding company's boards. There's nobody looking out for the bank itself. All of the directors of the bank subsidiaries are working on behalf of the holding company. So I wonder, and this is a thought proposal that I'm in the process of writing up, it seems to me that we should have some directors of large bank subsidiaries who are independent of the holding companies, who are actually looking out for the banks to make sure that the banks are being managed for the bank's behalf and not on behalf of the holding companies. This approach has some precedent, right? In the rule that the FDIC issued last year, outlining the requirements for new industrial loan company charters. The FDIC is requiring that industrial loan companies have more than 50% of their directors independent from their parent companies. If that is a good rule for industrial loan companies, I think it's equally applicable, if perhaps even more so, to financial holding companies. So I'm in the process of writing this up. There's some nuances that I'm happy to get into. I recognize we're time constrained and I want to hear Lev's thoughts on supervision. So let me stop there, and I'm happy to throw it over to Lev or Jennifer if you want to tee up a question for her.
It's been thrown to you, Lev. You have the
Okay,
mic.
great. Thank you, Jennifer. First, I just want to echo Jennifer and Jeremy's comments and thank Art for everything he has done to encourage and to mentor me. Art's not just a great scholar, but a great person, and his enthusiasm and energy are infectious. And I'm so grateful to have been able to work with him and get to know him over the last few years. Also want to jump in where Jeremy left off and applaud him for crafting what I think is another really creative and actionable policy solution to a specific problem. In sort of paper after paper, Jeremy's work displays the best of both the art and the science of financial regulation, identifying specific issues and crafting solutions that are workable that we could actually pursue productively in the short to medium term. And one way I think that Jeremy's independent director idea can really have legs in practice is if supervisors hold these special bank directors responsible, not formally, but informally, for risks that a conglomerate takes that are disproportionately negatively impacting the bank. So when supervision of financial conglomerates is at its best, it involves not just ongoing dialogue with management, but ongoing dialogue with the board. By holding board members accountable to the public and not just to shareholders, agency officials enlist them in overseeing management and ensuring that conglomerates don't take excessive risks. So while in the absence of supervision, you can sort of imagine, Jeremy's special bank directors all sort of taking a similar line as management or as the other directors on controversial matters, just because of groupthink and everyone wanting to be on the same page. But when you add in the complexity of supervision, you can actually see how supervisors can help give real teeth to an idea like Jeremy's. And by treating these directors differently from the other directors, and done right, you can sort of imagine bank board directors saying to their colleagues, the special Jeremy director saying to their colleagues, I'm not comfortable with this. The folks at the Fed are really going to ream me out. They're really going to ask me a lot of questions about this if it goes wrong. And it's this sort of textured understanding of how bank governance really works that I think makes Jeremy's work so valuable. And I am excited to see where he takes this particular project. Now, let me say a few things about supervision, because none of this is going to work if supervisors are not engaging with boards at all, and if agencies are proceeding largely through bright line notice and comment ex ante rulemaking. And so I want to make a couple points about what's come to be called desupervision. And we've seen two major periods of desupervision in the past 30 years. The first began in the 1990s and culminated in the global financial crisis. And the second began at the end of the Obama administration and is continuing today. And both, I think, and this is in line very much with what Art has been saying just about the whole time, are the result of conglomeration. The first was actually self-consciously so. It's amazing to go back and read the speeches that policymakers made in the late 90s. The Greenspan Fed explicitly said that it did not think conglomerates could be supervised through traditional means. Greenspan thought that the trading and markets businesses of the new complex bank conglomerates were too complex, too fast moving, and that supervisors would not be able to keep up. And the Fed developed risk-based capital rules explicitly so that market participants could discipline conglomerates instead as an alternative to supervision. And the new regime was conceived of as for the large conglomerates, de-emphasizing discretionary ex post oversight by special government officials and converting to a sort of more traditional regulatory notice and comment bright line rule methodology. And this went terribly wrong because the Greenspan Fed failed to take into account seriously that shareholders have different incentives from the public, and they want to take socially excessive levels of risk. And so they arbitraged the risk-based capital rules to the point where they were of little to no use in protecting the public. The more recent turn against supervision has been based not on the idea that the market knows best, but on legal claims about due process and transparency. It's an administrative law critique. But the success of these efforts over the last 4 years, I think, can be attributed also to conglomeration. For its conglomeration that has undermined the normative foundations of supervision and allowed the conception of banking as private activity to grow. And it's that conception that undergirds the administrative law critique of supervision. So in some forthcoming work, I explain why supervision is actually part of something I call the American monetary settlement, a larger political economy of how banking is supposed to work in the United States. And the idea was we would use banks to expand the money supply. We would separate banks off from other commercial activity, including other financial commercial activity, and we would keep close tabs on banks to make sure they don't exercise their public powers in ways that hurt the public. And that's supervision. And that practice goes all the way back to before the Civil War, and its distinctive, discretionary, informal nature also dates back that far. And when banks were separated from finance and prevented from conglomerating, which was for most of American history, supervision was built to succeed. But the rise of universal banking and shadow banking has really undermined supervision and made it much harder. So shadow banks, they're firms that expand the money supply without a banking charter or corresponding oversight, and more, they have de facto backing of the central bank. And that makes it hard for supervisors to justify their special oversight of banks because they don't have that oversight of shadow banks in many cases. Universal banking means supervisors have to oversee complex businesses. This is what Greenspan was talking about. The government has no special role in administering in the abstract various market-making activities. But because those market-making activities are interconnected with the monetary activities of a bank, they really matter for monetary system stability. And so we've got everything tied up in knots. And a further dimension that I think Art has been very good on is that conglomerates have vast legal, lobbying, and consulting resources at their disposal. And so they're much more capable of, as a practical matter, resisting supervisory discretion, and they're less vulnerable to punishment. So in the face of these conglomerates, agency personnel themselves prefer bright line rules, which will reduce professional risks to them. It will just make their jobs easier. And so we can expect to see sort of constant conflict over supervision as long as these structural dynamics persist. We'll see industry pressure, and it's not that supervision of conglomerates is impossible, but it's much harder, and we need to rely on techniques like robust stress testing and other creative solutions that Jeremy will hopefully come up with to make a system like this function.
So thank you both. I want to make some comments and then get us into dialogue, and I also see we have a question in the Q&A. I mean, I'm left kind of with a few reactions again, reflecting back on something Pat McCoy said, which was, it's not likely that the stars are going to align in such a way that we get to break up the conglomerates, right? And then on that same panel, Anna Gelpern said, so what do we need to do? Eat lettuce, take vitamins, and pray hard, right? And so I was hoping, I thought eating lettuce, taking our vitamins, and praying hard was, that's the metaphor for me for governance and supervision. And now you're telling me none of those things might actually work. And what I'm brought to then is, Simon and Anad Mahdi, who's on here right now, it's the capital stupid. Is that what we really, if this is either a black box because of complexity or a gated off fortress due to the power of these conglomerates, tell me what's the best thing, I'll throw this both to Jeremy and to Lev. What are of all the things that you're working on, what is the most promising and the most important that you think right now could actually get done to make a difference?
Yeah, so great question, Jennifer. And let me just pick up on Lev's point about the political valence and the political power of the large conglomerates and how that connects to supervision. I mean, we've seen over the past 4 years, Vice Chair Quarles at the Fed target supervision or de-supervision in a way that's been pushed by the large banks with their strong political power. And I worry a lot about what's going to happen in the next 4 years when whoever the new vice chair is going to try to ramp up supervision. Again, there's a lot of landmines that have been planted in the supervision field, things like the regulators' rule on guidance. And I worry about the next time a supervisory action is taken and banks are going to go running to the courts, and the courts have been populated with Trump administration appointees who are less likely to be deferential to supervisory discretion. So I think that step number one has to be addressing that political PowerPoint that Lev articulated and that Art has been so keen in pointing out. The exact mechanism for getting there, Jennifer, I don't know. I tend to like my Section 4M revoke FHC authority because it's already there in the law, right? What we're looking for is mechanisms that pro-regulatory regulators can take without requiring congressional intervention, because we know how unlikely congressional intervention is. So that's one that I think is low-hanging fruit, but I'd be curious for Lev's thoughts.
I agree with everything that Jeremy said. It's undoubtedly the case that while there has not been an adverse decision yet, the current judiciary is likely the least friendly to supervision in 100 years or possibly more, because they've embraced a particularly flattened view of administrative law and are likely to conclude that banks fall on the private side of the private-public divide and try to treat them accordingly. And so that's something I think we need to be very worried about. I would push back a little bit on the vitamins and prayers and lettuce, not because I have anything against those things. Lettuce can be quite tasty, and I take my vitamins, but I think there are huge political majorities in favor of a financial system that works for all Americans, and the party system has in a variety of ways obstructed efforts in the past to make structural reform, as has the nature and state of academic knowledge and understanding of what sorts of structural reforms we need and how and what they would look like. I think we've made enormous strides on the latter, and I think that there is some instability in the party system. And so I have some optimism that there is a potential for statutory action here. I completely agree with Jeremy that there's enormous latent authority. The Fed has enormous latent authority. So in the meantime, everybody should be pressing the agencies to use all the authority they have. Part of the point I was trying to make earlier is, despite having enormous authority, they just stopped using it. And that's part of how we ended up with the financial crisis in 2008. Safety and soundness is an extremely capacious authority. So unless the courts are going to step in and prevent you from using it, you have so much you can do. And then just to end on a bit of a gloomy note, of course, we're only one crisis away from an opportunity to do a more fundamental statutory restructuring. That crisis could easily have happened last year if it wasn't for the heroic response of the Federal Reserve. Not that I don't have things that I would criticize about how they've handled things. They put out a massive run across the shadow banking system and saved us from a Great Depression. But their efforts, which were historic in their size and their scope, ran into the trillions of dollars, were buttressed in some respects by the fact that there was a pandemic going on. I wonder if if the exogenous shock was not a pandemic that had hit public health, but was just something else, maybe even an own goal like 2008, a financial system created exogenous shock. If that was whether the Fed would have been able to roll out the necessary multi-trillion dollars that it did, and because if not, we would have ended up, I'm quite confident, in a repeat of 2008 in terms of a severe recession, possibly more severe. And in that case, it's really important to have done all the work that Art has done over the last 20 years, getting us to a place where we would be able to finally make the adjustments that are needed to rest the system on a more stable foundation.
So let me thank the panel. I have to keep the trains running on time here. Thank you, Jennifer. Thank you, Jeremy, thank you, Lev. That was amazing. Hopeful to read all of your scholarship very soon on this. Art, I think one message we're getting here is you're going to have to write multiple books just in response to everything that people are saying. So you're not going anywhere. You're going to be working hard there in South Carolina. No hanging out on the beach. Our next panel, it struck me that the conference is very heavy on banking law scholars and what the dismantling of Glass-Steagall looks like from a banking and systemic risk perspective. But there were two other industries that were subject to Glass-Steagall. It was supposed to separate banking, securities, and insurance. And I don't know about you folks at home, but every time I think insurance law, I think of our next panelist, Dan Schwartz. Dan is an amazing scholar with both an enormous impact in scholarship and in policy in the insurance law space. He is the Frederickson and Byron Professor of Law at the University of Minnesota Law School. And he'll be handling insurance. We've already heard from a few securities gurus, including Lisa Fairfax and Jennifer Taub, but you can never have enough securities regulation. So when Dan is gone, I'll talk a little bit more about securities law. So take it away, Dan.
Thanks so much, Erik. And I'll also start off where so many other speakers have in thanking Art for all of his support over the years. You know, as an insurance law scholar, things can get a little bit lonely, particularly if you're not doing sort of tort law, but you're actually looking at insurance regulation. And very early on, Art provided support for me in articles I was writing in this space and was just immensely generous and kind. And so I think it's notable that, you know, it's one thing to want to help people who are doing what you are doing. Not that any of the folks who've received help from Art should take that for granted. But the fact that he was so generous with someone who worked in, let's say, a field that is at least adjacent, if not several steps adjacent, I think really just magnifies the extent of the generosity that's clear from his work. So what I want to do is take the idea that we should have a new Glass-Steagall bill seriously from the perspective of insurance. Because I think, as is true in Art's great book, and has been true throughout this session, a huge percentage of the arguments that are made and the analytical power for Glass-Steagall has to do with the potential toxic mix of having securities operations and banking operations under the same financial conglomerate. Indeed, if you sort of think about many of the core arguments for Glass-Steagall, and many of them that are, I think so wonderfully discussed in Art's book, a lot of them really fundamentally, at the end of the day, they don't mention insurance at all. They're about the fact that securities and banking are fundamentally incompatible, even if they're conducted by affiliates under the same corporate umbrella. So just to be specific about this, when we think about sort of the generation and sale of risky assets, something that we saw in the lead up to the Great Depression with, for instance, the sale of foreign bonds, something we saw in the lead up to 2008, which is, I think, one of Art's primary arguments for why 2008 really was about universal banks. Those were really conducted principally by the banking organizations, which originated the mortgages, and the securities organizations that packaged them together. Now, it's true that in some contexts, insurers played a role in that. And in particular, AIG, of course, issued credit default swaps that allowed for the residential mortgage-backed securities to enjoy a patina of additional protection that then allowed them to be rated more favorably. And moreover, monoline insurers that just did mortgage guarantee insurance under state insurance law also provided support. But what's notable about that description, of course, is it didn't involve affiliates at all, right? AIG and monoline insurers were facilitating the mortgage-backed securities production pipeline without having to be affiliates at all. And so there's a sense in which I think that if we think about that as one of the primary drivers for wanting to create a new Glass-Steagall, arguably its fit with insurance is a little limited. There are other, I think, difficulties with trying to lump in insurance with banking and securities. So for instance, I think another really important argument that we've seen really throughout since the Great Depression, and I think again emerging in the 2008 crisis, is that securities operations are inherently risky in a way that's incompatible with sort of the conservatism we want in banking. And at the end of the day, when you commingle those under the same financial conglomerate, you end up having culture problems where the culture of securities seeps into the culture of banking. You end up having problems where deposit insurance is used to fund some of this risky behavior. And again, I think there's a pretty plausible argument to be made that these arguments don't really apply to insurance. You know, at the end of the day, actually insurance is a quite conservative, at least traditionally, branch of financial services. And it's one where you usually don't see the riskiness you see in securities. And to the extent you see risk, much of it is not actually market risk, right? I mean, a lot of the risks that insurers face are not, you know, there's obviously some market risk, but a lot of it also is distinct from market risk. It involves the likelihood of claims and potentially quite significant claims that are correlated at a particular time. Now I could go on, but I think that there's also, I think, you know, some benefits to affiliation between insurers and other entities that one could sort of think about and say, well, gee, I'm not so sure whether or not we should really endorse the idea that we want to segment a new Glass-Steagall that really applies to insurers as robustly as to banking and securities. So for instance, I do think that there are some potentially plausible arguments for synergies that exist, particularly, I would say, across the insurance and securities divide. Many insurance products, particularly life insurance products, really offer protections that overlap very substantially with securities products. And you might imagine that actually being able to offer a full suite of advice to a customer might be beneficial to say, well, we have some insurance products, we have some securities products. And so trying to segment that out might be difficult. And even some insurance products actually piggyback on securities products. So for instance, some insurers might own a broker dealer to manage securities that underlie a particular insurance product. So I think that there are, you know, there are actually even some other examples as well. Actually, property casualty insurers that own banks sometimes use those banks that they own to actually make claims payments. So again, on the one hand, you know, I think I start off with some skepticism that we completely need to divorce insurance from either banking or securities, and that insurance is the real culprit here. It gets thrown in because I guess that's the way it started out with. But then on the other hand, I think that there's some really important ways in which the sort of objections that I've just laid out are not applicable. And I want to now think about, sort of lay out the other side of the argument about why maybe Art is right. Maybe we do need a new Glass-Steagall that actually extends to insurance. Because I do think that some of the arguments that we've been sort of talking about today and that are laid out in Art's book do have some nice application to the insurance context. So the first one I guess I'll point out is the political power argument. And it's one that we've heard in prior panels, that financial conglomerates, if they get too large, can essentially undermine the capacity of regulators to engage in effective supervision because they have too much power and can roll back regulation. And I think that that is assuredly true if you have financial conglomerates that include insurers, because insurers have a lot of political power that I think is different in kind than the political power that banks and securities firms have. A lot of their political power has to do with networks that are local. And a lot of it, I think, can end up, if combined with political power on the banking and security side, to really prove, I think, overwhelming. And I think Art does a really nice job discussing about this in the context of Citigroup, which actually was able to engage in a transaction that, probably shouldn't have been, was very unclear whether it was actually going to survive, but they sort of got pre-approval by no one less than the president himself of that transaction, I think in part because of the power that that newly formed entity had. So I think that's one reason to be concerned about financial conglomerates that include insurers. I think the second really important reason really involves too big to fail. And in this context, I think AIG comes back in, of course, because one of the things that we saw in the context of AIG was that it was able to become too big to fail by leveraging many of the assets that the insurers within that group held and using those assets to effectively create shadow banking, right? So if you think about AIG's problems in the context of 2008, a lot of times we focus entirely, or many people focus entirely on credit default swaps. And that was a huge part of the problem. And as I said, to me, the credit default swap story is not one that suggests the problem is one of affiliation. But on the other hand, if you think about the securities lending problem, what AIG was able to do was to use its insurance companies, investments, and securities to effectively create a shadow banking product, a product that created claims by counterparties that they believed could be, and in fact could, undo at any moment. And so when they became concerned that AIG was having these larger problems, they attempted to unwind those transactions, and that created a run-like dynamic that I think was exacerbated by the credit default swaps. There are other arguments, I think, as well. So for instance, I do think that there's some consumer protection concerns that arguably can be used to support this. And I think Adam Levitin mentioned one earlier on, where Wells Fargo used the fact that it had a captive reinsurer to actually receive kickbacks by force placing insurance, or not even force placing insurance, in some contexts just selling private mortgage insurance, and receive kickbacks in a way that was a bit more opaque than just sort of ordinary commissions via the assurance of future business for its reinsurer. So at the end of the day, I think that there are a lot of arguments pro and con. I think that if I'm going to have sort of balance it, I would say that the case for segmenting out insurers as from securities and banking is not as strong as the case from separating out banking and securities, but also entirely plausible. And so then that leads me to the real question that I guess I'll spend the rest of my remarks on. How much time? I'm already running out of time, aren't I, Erik?
Well, let me sort of play law professor here, right? So
I play law professor all the time.
I pretend to be one, as my students can tell you all the time. What I really prefer is a one-handed law professor, right? Who can't say on the one hand, on the other hand. So let me push you a little bit in favor of why Glass-Steagall might be necessary in an insurance context. One, you mentioned AIG. AIG, a lot of the operations that got it into trouble were regulated by the Office of First Supervision, which was a disaster. Number two, there's a lot of work that I think still has to be done in terms of if you have a bank and a securities firm that has an insurance arm, are they using subsidized financing, right, to undercut rivals that don't have banks and securities arms? And is that causing the AIGs of the world, right, to enter into riskier market spaces that they otherwise wouldn't if they didn't face that kind of subsidized competition? The third point, I think, and thing that I think that you're going to agree with, is that consolidated supervision is sorely needed in the insurance world. And even if it can't be done adequately, or it's not being done adequately per Jeremy and Lev, like it does seem like that's a pretty strong argument, if not for reintroducing Glass-Steagall, for doing something radically different in currently insurance markets. And then the last point is, I think there is a value, a political value in Glass-Steagall to engineering some interest group competition, right? So in the 1980s, securities groups and banking lobbying groups were suing each other's regulators, right? To try to limit the risk-taking and the encroachment on each other's turf. And obviously that didn't last very long. And at some point it was, if you can't beat them, join them, right? But there is a political dynamic in terms of having some get separation among interest groups as well. Do you want to address that in the last 5 minutes?
Absolutely. So let me try to combine your points about OTS, AIG, and consolidated supervision, because this is something I've written a lot on, and I think you are right on to say that this is one of the big deficiencies. That's where I was about to go, actually. Right now, I really do think that state insurance regulation purports to provide consolidated supervision, and consolidated supervision, really the lack thereof, is really, I think, what was behind the AIG failure. State insurance regulators didn't have a good understanding of how AIG's credit default swaps operations were working, but they also particularly didn't understand the ways in which the credit default swap operations and the securities lending operations created correlated risks. They were really both about betting on residential mortgage-backed securities. And so when those blew up, these two sides of the firm blew up at the same time. State insurance regulators didn't see that. Now, OTS didn't see that either, of course, but I think that's attributable to other problems that OTS had that, arguably we've solved through Dodd-Frank by getting rid of OTS and having just one bank regulator. But the problem that I have, and this is actually one argument, again, I have on the one hand, on the other hand approach to this. I really do think that we have not saw that we shouldn't have a lot of faith in consolidated supervision or group-wide supervision by state insurance regulators. And the reason for that is, who does that regulation? Well, it's the lead state insurance regulator. Who's the lead state insurance regulator? I don't know. Actually, the rules on who gets to be the lead state insurance regulator are incredibly fuzzy. And basically, a firm has a lot of say in which of its various regulators gets to be the lead regulator. It can be where you have the most firms domesticated. It can be where you have a regulator that volunteers to do it. It can be a place, so there's already sort of a shopping for a lead regulator dynamic. And then when you think about what a lead regulator and a state insurance regulation has to do, we don't really have any time-tested model for it working. And I think there's something fundamental about state insurance regulation that really focuses on insurance entities to the exclusion of consolidated regulation. At the end of the day, the reason why we developed this entity-based and entity-centric model was because it worked in the context of state insurance regulation, where if you have an insurance entity, it can be regulated by one state insurance department. But if we're asking, the Ohio Department of Insurance, or the Missouri Department of Insurance to regulate a massive, a multi-billion-dollar financial conglomerate, I don't think they have the incentives to do that in a way that is actually going to focus on potential systemic risks, potential ways in which that company's failure might impact not only people in Ohio or Missouri, but the entire country and the entire world. The incentives just don't make sense, and the resources just aren't there. And so I think that, those are really important reasons. Now, again, this leads me to sort of say, well, I don't know. And because actually, one of the only ways in which we get effective group-wide supervision of insurance-focused companies is by the fact that insurance-focused companies that own a depository institution are thereby regulated by the Fed on a consolidated basis. And so there's part of me that thinks, oh my gosh, if we have a new Glass-Steagall and insurance is completely separated from banking and securities, we're going to totally lose any semblance of effective group-wide supervision, because we're not going to have any federal actor in there at all. And so, I think that the issues are complicated. I want to be respectful of our time, but I guess I'll just say this. on the point about banks and the extent to which the sort of subsidies that we provide for banks leak into the insurance context, I think that's a real problem in theory, but I would say we don't see much evidence of it in practice. Most of the insurers that own depository institutions, they're actually not the biggest ones. They actually usually own pretty small banks. And I don't see any systemic risk concerns in nationwide insurance or in country financial insurance or in USAA or other insurance-focused entities that own banks. Now, I'm not saying that couldn't happen, but I actually tend to think that the biggest problems, at least with affiliations, are the insurance and securities affiliations, as illustrated by AIG, because you can use not only the assets of the insurance companies to engage in very risky securities operations, but you can do it in a way that sort of can potentially replicate shadow banking structures, as in the securities lending context.
So I think we have time for our last panel. Thank you so much, Dan. I will note there's a Q&A question in the audience from Anna Gelpern, and you and I have to answer Anna Gelpern's question offline. I will be in a world of hurt.
I can assure you we will do it.
No, we don't want to anger Anna Gelpern. Thank you, Dan. Again, we're going to have a whole new conference just on follow-ups on all of these topics. Like if we rerun the conference tomorrow, one of the first questions Jeremy will ask Mark Vander Weide is, how good is consolidated supervision by the Fed of insurance? So our last panel, we're going to bring it home. I owe an enormous debt of gratitude to Dennis Kelleher, who is responsible for putting our last panel together. And for those of you who know Dennis, he's extremely shy, but I could tell when I invited him to be part of the conference that I could tell he had an idea, and it takes a while to tease the idea out of Dennis. So Dennis had the brainstorm of inviting John Reed to participate in a conversation with Art about Art's book. So I will let Dennis introduce John and bring our conference all the way home. Thank you, Dennis.
Thanks, Erik.
You are the CEO, co-founder and president of Better Markets, which is the scourge of a lot of Wall Street lobbyists. So thank you for your work, Dennis. Take it away.
Thanks, Erik, and thanks for putting on a really terrific conference today. I mean, it is a great public service what you've done, and the all-star cast has been remarkably informative and interesting, and it's going to be a long-time resource for many of these key issues. I'm delighted to be here with John Reed and Art. At this point, Art really needs no introduction, but I'm going to say a few things anyway, and he knows he can't get away with me not commenting. But first and foremost, I really want to say this conference began many hours ago with Erik mentioning Art's courage. And I want to emphasize that. I can tell you based on firsthand experience that the most powerful financial institutions in the world, particularly the megabanks on Wall Street, don't like to be opposed. Their influence, access, money, tentacles, and power are everywhere. It's in the economy, it's in the financial system, it's in the federal, state, and local governments, it's in the courts, it's in the media, and yes, it's in the academy. And many people who presented today know that, and many people listening know that. And they also know they aren't shy about using those assets to promote their agenda and protect their privileged positions. Now, it's remarkable that over a very long career, Art has never let any of that have any impact on him. His independence, his research, or his scholarship. And so his latest book, in my mind, is a testament to all of that. And it should be read by everyone, not just for its content, but also for its status as a symbol of academic freedom. I'd also like to say that it's been a pleasure to partner with Art over the entire 10 plus years of Better Markets. He's been a good friend as we jointly dealt with so many financial and economic issues, him in academia, Better Markets in kind of the regulatory and legal arena, and then both of us in the policymaking arena. It's been an honor and a privilege to work with him. And, there really can't be much more added than the encomiums that have been said all day long, all of which I heartily endorse. Now, talking about courage is actually a good segue to introduce John Reed, although he would likely deny it. When introducing John, people typically focus on what he did when he was at Citibank and Citigroup, starting in 1965 and spanning all the way through 2000. There were lots of milestones over those decades, culminating in the merger of Citibank with Travelers in 1998, which have provided him with wisdom and insights. I'm reminded of the old saying that, wisdom is essential, but wisdom comes from bad experience. So I think we've all got way too much wisdom for all the wrong reasons, but we're going to benefit from the wisdom and insights of John in just shortly. However, I wanted to note that John is the only senior executive of a too-big-to-fail mega bank to genuinely reflect on the 2008 financial crash, its causes, and his role in it. After doing so, he concluded that the arguments for and the claimed benefits of repealing Glass-Steagall lacked merit. More remarkably, he spoke out publicly, he shared his thoughts, he admitted fault. That's true, he admitted fault, and he's still sitting here. He was not struck down by lightning. He admitted fault, and here he is, true. And he's become an advocate for a new Glass-Steagall Act and other reforms to protect the economy and the financial system from the very serious dangers posed by the too big to fail, too big to jail, too big to manage, too big to regulate megabanks. Now, I'm not going to go through all of kind of John's post-crash thinking, but I've posted it on the Better Markets website homepage. And if you want to know the details of it, go to our website and you can see how John has advocated, having thought, reflected genuinely and honestly, and spoken out publicly. Now, as a uniquely informed practitioner of banking at the highest levels, John speaking out has made a significant contribution to the discussion. Among other things, he's robbed the industry of claiming that those objecting to the wisdom of the banks are only a bunch of, academics, advocates, elected officials, regulators who really know nothing about banking. John knows banking. That speaking out took and takes courage, and we've all benefited from it. So with that, we'll hear from John and then have a discussion with Art about John's thoughts, Art's book, and where we go from here. John, over to you.
Thank you very much. And thank you, everybody, for inviting me to this conference. I've been with you most of the day. I'm not sure, having heard a lot about this, that necessarily I'm a natural participant here. Art and I have spoken a little bit, and I think we're going to have some fun talking together. Dennis, I think you pushed me a little far. I'm not advocating anything. I've been asked about opinions, what I've learned, and I've been willing to share them. I am happily retired, and I do not advocate for any particular one thing or another, but I do share what I've learned. I read Art's book, and he and I had a moment to talk, and I have not been a scholar. I'm not a lawyer, and I can't share some of the comments that have been made during the day about his having trained me. But we'll have some fun. I do think that his fundamental theme is correct. His theme, as I understand it, is the financial sort of system represents a real risk to the real economy. We have seen over history that there have been problems with the financial sector that have spilled over into the real economy and caused very, very serious harm. And I think that situation continues to exist. I don't think it'll ever disappear, but it certainly can be attenuated, and it's worth thinking about. I'm going to sort of shift my own reaction to Art's book between thinking about markets and thinking about institutions. Glass-Steagall obviously is about institutions, separating banking institutions from security institutions and possibly insurance institutions. But I think we should think about markets themselves because they've changed an awful lot. I came into the business in 1965. Banks made 90-day loans. Pretty much that was it. Markets were quite peripheral. There were stock markets and bond markets, but they had nothing to do with the banking system. Markets have taken on a totally different role now. They are of an importance that can't be overemphasized. They've also been a source of a very fundamental shift in managerial practice. It's the people in markets, and this happened during the 90s. I sort of saw it occur. People in markets felt that, they had not been doing all that well, and they pushed and have been successful in convincing management that shareholder value was to be the main sort of source of grading a managerial activity. And they've been successful. I think they're wrong. I think shareholder value has some basis for existing, but I don't think it's the be all end all. And frankly, I don't think you could run a company if your only objective in life is shareholder value. You better have some other idea in mind because it doesn't give you any guidance. And we have a number of cases where shareholder value have gotten very successful companies into trouble. General Electric, Boeing being examples that you could easily cite. But it was the power of markets that brought this idea into managerial practice. I watched it happen in the 90s, and it has taken hold much more since I've left the business. And we should keep in mind that markets have had a big cultural impact on business. Markets are more efficient than institutions. Some of that reason is for accounting reasons, but when markets can solve a particular problem, they pretty much take the institutions out of the business. When it first became acceptable for markets to take on the mortgage business, and you got mortgage-backed securities, et cetera, it no longer was economical for any institution to hold mortgages on their balance sheet. And so as markets develop an ability to perform certain functions, there's no question but that they disintermediate institutions. And this is a very strong force with which we're currently living. I do think that we should understand that markets only deal with rated companies. If you do not have a credit rating, markets are of much less interest to you. The banking institutions are your primary source of credit. And so when we're talking about markets and their impact on banking and so forth, we should understand that you're dealing with those entities which by number do not make up the majority of the private sector, but by economic impact probably do. You're dealing with them in terms of the people who have access to markets. Markets also have a very interesting characteristic, and it bears on some of the things I heard today about the opaqueness of banking and risk-taking and whether institutions can really understand the risk that they have and managerial ability. When markets take on risk, they deal with it statistically. They deal with what is the probability that this particular instrument will change value. It might lose value, et cetera, et cetera. And all of a sudden, we are talking about participants in markets who are basically buying and selling probability functions. What is the probability that this particular instrument has the value that we're talking about today and will have it tomorrow. Institutions take on risk by making specific assessments of the likelihood of being repaid. You put it on your balance sheet, you get a chance to figure out how it goes, but you're looking at it one at a time. When banking dealt strictly with individual credits, it was much easier to supervise. It was much easier for the board of directors to have some sense of what risks were being taken. When you start having an institution that has substantial portion of its risks in entities, in instruments that are being bought and sold daily on the market, you cannot describe risk in the same way, and it becomes quite unintelligible to anybody except the most experienced practitioners. And that's certainly true. And I guess Greenspan recognized that. He had been on the board of Morgan Bank before becoming chairman of the Fed. And he and I had some arguments about, the tie between banking and markets. And he understood very well that you had to go to this sort of risk-based assessment of what you were doing. And that's because all of a sudden you were dealing with instruments that were simply described by probabilities of going into default or rapid changes in value. I would also say that markets attract certain people. If you line up 100 people who have just graduated from school and ask how many of them want to go into banking, it used to be that it were the extroverts, the people who were socially oriented, who liked other people, enjoyed the fact that as a banker, you would deal with people in large companies and so forth and so on. The people who said they wanted to go to Wall Street and be involved in the securities business were people generally who cared about their own net worth. And it was really true. I mean, I interviewed a lot of people at Citibank who were coming to work at the bank, and you said, what is it that you're trying to do? What do you want to do 10 years from now? And when people said, look, making money is very important to me, I said, go down to Wall Street. You're not going to make a lot of money in the banking business, because in those days, bankers were paid more or less than most of our corporate customers paid. Banking was not a particular good way to earn a lot of money until this change that we saw coming in the 90s. And so the types of people and the culture that surrounds market making activities are different than the types of people who traditionally had gone into the banking business, and who probably are the people who go into the smaller banks that deal with communities today. Let me talk about institutions for a second. Customers have a lot to do with shaping institutions. I had a lot to do with the breakdown of Glass-Steagall, and I could tell you very simple, why did it happen? It happened because our customers said to us they wanted access to the capital markets. And they said that because they could get the financing they wanted more cheaply by dealing with the capital markets than they could by having term loans from consortiums of bankers. And so there was a lot of pressure from our customers saying, hey guys, you have to be in a position to introduce us into the capital markets. That obviously you listen to your customers. If you're running an institution and a customer says to you, hey, we need this other product, this other service, you take a look at it. When Sandy approached me and said, hey, why don't we merge? And it was he who approached me. My instinct was to look at the finances of merging, and frankly, the two companies fit together very nicely. If you create a matrix of customers and products, we didn't overlap very much. We weren't going to have to lay off a lot of people, and we were really in quite different businesses. And it would allow us, due to Sandy's ownership of Salomon Brothers, it was going to allow us to introduce our customers to the financial markets and allow them to issue securities and so forth and so on. And we felt that that was something that we wanted to do. As I've said publicly, it turned out to be a mistake. And it was a mistake in many ways for cultural reasons. Running a market-making business requires very different skills than running, and in my case, an international bank. And what happened is when the two companies came together, we did very well with our customers. We were able to do everything that they had wanted us to do with the customers. But of course, we became traders. We got into the middle of the mortgage-backed security problem. Fortunately, I had retired by then. But, and they took on more risk than they knew. There was a comment earlier in the conversation about what is the solution. I've heard a lot of ideas about how you could better regulate the banks and better manage the banks and so forth and so on. The real solution is capital and liquidity. I mean, the only way that you could take the kind of risks that some of these entities are exposed to is by having a lot of capital and having good liquidity. The idea of funding massive positions with repos and overnight money and so forth and so on is simply inherently risky. And we saw it. And by the way, the opaqueness as to what your competition is doing makes it very difficult for you to help fund them. So, you get into a crisis and all of a sudden people are saying, hey, what's going on in Citi? Are they creditworthy? And of course they don't know. I went through the real estate crisis in the 90s and I spent an awful lot of time going around the world and briefing the heads of all of the major banks as to just what our situation was. And I did that because we depended upon them for liquidity. And we had a tremendous deposit base, but it made a difference as to what the governor of the Bank of England thought was going on with us. Whoever the lead bank in Japan, they change every year as to who's the head of the Japanese Banking Association. But you wanted to brief that person so that when the gossip came, hey, what's going on at Citi? Are they creditworthy? They'd say, oh yeah, Reid was here last week and this is the nature of the problems they're dealing with and so forth and so on. And of course, in the capital markets, no one knows what somebody else's position is. And the result is a prudent person says, I'm not going to lend to them. And that's the problem. So I think this interinstitutional reaction in the context of a market makes for fragility. And Art knows this extremely well. The final thing I'd say with regard to consumer protection, this really is, I think the consumers need a lot of protection. I think the consumers need protection from any big entity. It's not only banks and financial institutions. Call your telephone company and try to get a bill changed, or call your utility, or call anybody else. The problem is big institutions tend not to pay any attention to their customers. And that is something that we should try to improve, because I think big institutions have to learn how to listen to customer complaints and how to solve those complaints. And it's not restricted only to financial institutions, but the discussion today about protecting consumers and so forth and so on is a long way from markets and Glass-Steagall per se. And so I found a lot of the conversation interesting and important. And the final thing I'd say is my boss, Walt Wriston, who left the bank in 1984, he said, and I've always believed, that banking's an information business. We're nothing but an application on a digital network. So when we think of fintech or tech fin, depending on how you like to call it, it's coming. For the consumer side of the business, not for markets, but for the consumer side of the business, there's no question, but the existing structure of the industry is not going to solve the problems. It is going to move towards the digital world. And hopefully it'll do so in a way that produces better results for everybody involved. But I don't think we should believe that it isn't going to happen. I think it is. So these were sort of my reactions to reading Art's book, and more importantly, to talking to him a little bit. And so why don't I shut up, and Art and I could talk. Dennis, you could add your 2 bits if you want.
Thanks, John. Before I kick it over to Art, I just wanted to pick up on one of the things you said at the end, John, and ask if you could just tease it out maybe a little bit more. You mentioned kind of consumer protection, which relates to bigness, which isn't, of course, unique to big banks, but big banks are our subject. So let's stay on that for just a minute. I think one of the really fascinating things you've talked about, John, is how there's been this shift from, pick your time period, the 80s to the 90s, where you have capital markets access being demanded by bank customers. And then a corollary to that were the fact that shareholders became the primary interest of financial institutions. And it seems to be a tension between the primacy of shareholders and the primacy or even the protection of customers. And I'm wondering if you thought about how you deal with shareholder primacy being driven by market access and customer demands, and on the other hand, protecting customers, or even having customers somewhere higher up on the priority list of the biggest banks.
Look, my own personal view, and it's very personal, I don't think shareholder value should be the driving force of a management. Obviously, shareholder value plays a role, but I always felt, and certainly this is the way the banking industry was managed when I first started out, if you do a good job for your customers, the shareholders will get good value. You don't have to focus on shareholder value, focus on the customers. If you do a good job for the customer, the shareholder will be fine. And this idea of having to kowtow to, responding to every time somebody who is a money manager has a different opinion than you do, you can't run a business that way. And so I don't think there's a conflict. My own personal view is focus on your core business. If you're building airplanes, build good ones, and just focus on building good ones. If you build good airplanes, you know what? You're going to sell them. And if you sell them, your stockholders are going to be pretty happy. I'm not saying you should be ignorant and you shouldn't understand what the profitability of certain businesses are or so forth and so on. But when I was in the business, we focused primarily on customers. That's one of the reasons we did the merger, which in retrospect, I wonder about. But I think that this idea of focusing first on the shareholder value blinds you to other priorities that turn out in the long term to be more important.
Great. Thanks very much, John. Art, why don't I kick it over to you for your thoughts and reactions?
Well, thank you very much, Dennis and John, first for being here and for your very kind comments and for sharing, your expertise and experience. Several things you said, resonated with me and take me back somewhat into my historical work and some of my own experiences. It was interesting you said that, in 1965, when you joined the bank, the primary business of banks was to provide really short-term wholesale type credit. I mean, banks at the size of Citibank, the public markets really were for longer-term capital. There were no meaningful repo markets then. There was no, of course, there were no money market funds until 1971. I think even short-term commercial paper was a relatively small market, and only the most blue chip type of companies could get it, as I understand, could sell it. And part of my vision for this book is it seems to me that was a world that the banks were very good at and played a very important role in. One more thing, I mean, banks were the center of the payment system. And we talked a little bit about Corrigan's idea about the transmission belt for monetary policy, that the Fed could really control monetary policy through the banks, through reserve requirements, primarily, and open market operations. But it was a much more stable, identifiable system. It seems to me that where we began to go wrong was to disintermediate banks in terms of short-term finance by saying, oh, let's allow the securities firms, mutual fund firms to offer these money market funds, and let's allow securities firms to underwrite commercial paper and to offer short-term repos. And then they even went further and said, oh, and let's offer bankruptcy safe harbors for repos, and let's prop up the commercial paper market when it gets into trouble. And I think part of that was that I think the Fed and other people wanted to get rid of Reg Q, and they saw money markets as a way to do that. But it's interesting that my question really comes to, if we went back to a system similar to that, where you say, and essentially you use 90-day paper. For me, 90-day paper and shorter would have to be inside a bank. That banks would really be the center of the payment system. We wouldn't have people outside the banking system really running the payment system. Banks would be providers of backup lines of credit, which is another thing Corrigan said, that they would be reservoirs of liquidity and backup lines of credit. Presumably banks could do syndicated loans, which would provide some competition. I mean, certainly they wouldn't have the equity underwriting business, and a lot of the bond underwriting business they wouldn't have. But would you think that we'd have a more stable system, and that banks actually could be successful within a system similar to what I've described, which is also pretty typical of the British banking system, back in the day, that short-term wholesale business, the sole collector of deposits, the payment system provider, the backup liquidity provider. You wouldn't be, as you say, you wouldn't be rich investment bankers, but is that an unviable banking system?
No, I think we both know that historically it was a system and it worked. Basically banks provided working capital for their corporate customers. They also have a consumer business, so forth and so on, but they basically provide working capital. Capital, meaning long-term bonds and equity, came out of the markets. And that was sort of the division. We provided trade finance. We had a lot of foreign exchange related to trade finance. But other than that, we were dealing with customers who needed working capital support, backup lines, so forth, so on. It's perfectly viable business. You could earn an adequate return. And your stockholders are going to be reasonably comfortable. You'll have a better PE, by the way. People always look at the price, but you should look at price earnings, and financial institutions reflect the volatility of their business and typically having lower PEs. And of course, then you'd have the securities business. Now, the risk to the economy about which you write would come out of the markets. There would still be that risk there. And the fact that the commercial banking sector, which in your definition would be involved in more traditional lending, they would be protected, and depositors and so forth and so on. You wouldn't have the too big to fail sort of problem. But you would in the securities markets and those who dealt in it. And you couldn't be sure that problems in the security markets would not have the impact on the real economy that we saw in 07, 08. So the need for people to think about the risks that are embedded in securities businesses needs to be addressed. Because a tremendous portion of the world's economy now goes through these security markets. And so those risks still would be there.
Right, and one question would be, as you said, part of the problem in 07, 08 was that the securities firms were funding themselves so extremely short, overnight money, basically backing up illiquid subprime mortgage-backed securities and worse. If the securities firms and some non-banks could only fund themselves with longer-term money and wouldn't automatically think that they would get bailed out by the Fed every time they got into trouble, would you expect to see the securities firms shrink somewhat? Would you expect to see credit shrink somewhat? I mean, everybody acts as if having more credit is a good thing, but when I look at the debt aggregates that we have now, I'm not so sure that having more credit is necessarily a good thing.
No, it clearly would have an impact. One thing about financial business, it's very malleable. In other words, it can change. This is not like building Model T vehicles where you have to change the assembly line. As the rules change, the industry responds. We're going to see it in England now after the departure from the EU. And you know what? They're going to all adjust. It'll be different, but it'll work. And stockholders will get a decent return. I think the securities markets might become smaller. You would have, they clearly are funded in an unstable way. And that's just inviting a problem. I mean, funding yourself overnight with some of these massive portfolios, it doesn't make sense. And so I think you would change the funding model and the capital requirements. And by the way, banks have traditionally supported the firms, Goldman Sachs.
1987 was a good example, right?
Absolutely. I mean, Goldman Sachs was a major customer of ours. And it used to be that the chairman would come up and reach into his pocket and show me the results for the year because they were a private company. Then he'd put it back into his pocket and leave because obviously we wanted to think that they were creditworthy, which they always were. But the point is the securities firms could get credit, but it would not be this repo style. And I must say, I've been surprised that the Fed was willing to come into the market and support it when there were some dislocations. It simply said to me that the Fed was more concerned about the markets than they were about the structure.
I was going to ask you about that, John. We used to talk quaintly about how those inside the safety net were more highly regulated to protect taxpayers who paid for the safety net. And as Art details in the book, not only are the banks less regulated to protect taxpayers, but now non-banks, when he wrote the book, were within the safety net as proved in 08 crash. And then last year, you get $4+ trillion deployed, bailing out banks, non-banks, corporates, junk bonds, PE, and literally everything else. So it's almost like the concept of the trade-off for the safety net protection for higher regulation doesn't really have a meaning anymore.
No, it's changed totally. There's no question. We should have learned when long-term capital happened. We should have understood at that point, because here was a firm that was not in the regulated world. They got into trouble. The trouble manifested itself in funding difficulties. It was thought that they were having problems that caused funders to back off. And there was a lot of learning there, which we simply failed to internalize.
And it's interesting that the Fed, I mean, you may have a view on this, but those of us who have looked at that episode believe that the Fed leaned on the big banks to rescue long-term capital management. And it's at least somewhat mysterious to me, that's an interesting contrast from 1990 when I think as someone commented earlier today that I think maybe it was Damon Silvers that the head of Drexel Burnham called up Nick Brady, the Secretary of the Treasury, and asked for a bailout. And Nick Brady said, well, aren't you a securities broker dealer? And yeah, we don't bail out securities broker dealers. So what do you think that the Fed actually leaned on the banks in '98, and why do you think they did it?
Well, I'm sure they did. Fortunately, my bank wasn't much exposed, so we were not part of the Saturday morning invitation. But it was funny because I looked at the people who did go to the Fed, and they were all our best customers. So we were only one step away. And but the answer is yes, the Fed undoubtedly leaned on them. And they did so because they were avoiding disruption. You know, sometime we failed to learn. There was a real lesson to be had there. Even if they had chosen to do as they did, they should have said, you know, we did something that probably was wrong, but we did it fine. But what should we learn from this? Because, you know, it was a forerunner of the problems that we ran into. And, you know, but I do think that what has evolved, and no one is bad. I mean, we're not talking about bad people, even though some of your colleagues this morning would have characterized bankers as being fundamentally evil. No one was trying to be bad here. It's just they were trying to avoid a disruption. No one wants to go to the Congress to explain why on their watch certain firms disappeared, and, you know, Continental Bank, et cetera, et cetera. And so regulators are human. They say, look, it's a lot easier to solve this if we can than to have a mess on our hands. Unfortunately, that leads later on to bigger messes.
Right. Each disruption gets bigger. You know, if you solve the one disruption, then each one gets bigger as more people figure they can pile in on the same bet. You know.
Yeah.
Although that somewhat relates to the almost willful blindness not to learn even the obvious lessons, which is curious how many times that happens. You know, John, one of the things that you have commented on, and you're uniquely positioned to comment on, is the thinking, and correct me if I'm mischaracterizing you, but, you know, going into the merger in 1998, you're looking at the metrics, or you do an index and you show that it actually works out pretty well because there's very little overlap. And one of the things that was underappreciated was kind of the fundamental cultural differences that different parts would bring to the whole. You kind of alluded to this before when you used to interview people, and people who wanted just to make money, you'd send to Wall Street, and the people who are interested in more traditional banking would join the bank. I wondered if you would comment on your thoughts on kind of the cultural problems of combining these two types of activities, and whether or not you think, as you said, kind of the real solution is capital and liquidity. And I wonder if there's enough capital and liquidity to be able to address what seems to be kind of inherently incompatible cultures.
Well, look, they're very different. Incompatible sort of answers the question. They're very different cultures. And, you know, the culture of traders is simply different. I'm not saying better or worse, different than that of traditional bankers. Managerially, it's really hard to have a foot in both camps. The statistical likelihood of being able to have 3 CEOs in a row who can pull this off is probably pretty small. No, it's a hard act to pull off. This is not the only industry that has these kind of problems. In the entertainment industry, the creative side and the distribution side are hard to manage together. You saw AT&T just recently decide that, you know, they had to create separation. So I'm not suggesting that there's something strange and different about finance. It is quite difficult to manage these cultural differences, and you know, so the complexity of management of a big institution that has a deep business both in the securities world and in the traditional banking world is difficult. And, you know, both the Bank of America and JP Morgan have a very traditional base business that came out of the old NCNB, the National Bank of North Carolina, which became the nation's bank, which became Bank of America. That's a mid-market consumer traditional business, very well managed. Hugh McCall did a wonderful job pulling that together. John McCoy, his father, and he built Bank One that then merged with First National and became sort of part of JP Morgan Chase, which is really the chemical bank writ large. And these banks have a foot both in a very traditional business and also in the money markets. And they're inherently difficult, culturally difficult, not impossible, but difficult.
Did you
I want to
find
get
that
Art's thoughts on where he says it's not that different than others like Time Warner and AT&T, except when they blow up, the taxpayers don't get the bill. So I'm wondering, Art, what you think of the analogy?
Well, I wondered too, you know, did you find that the pay scales of the investment bankers began to leak over into the commercial bankers because they would say, wait a minute, I don't want to be paid so much less. And hey, I'll take some more risk, you know, to get the short-term earnings out. Did you see it beginning to sort of change the outlook and behavior of the commercial bankers when they saw what the investment bankers were doing and how they were getting paid?
Well, yes and no. I think the real change came when you got into this shareholder value thing.
Yeah.
That was before. I think what happened when people got involved in shareholder value, they said, look, we want you to run the company simply to maximize the price of the shares. And by the way, we don't care what you pay yourself, as long as the shares go up. And that led to a bunch of, compensation based upon the price of the stock. And that changed the compensation. And that was really before the Glass-Steagall collapse and so forth. So it's certainly true that the people in the money market business, the capital markets, have always been better paid than the traditional bankers. I don't know what it's like for JP Morgan and Bank of America now, but they certainly can't run their nationwide banking systems, their branch systems across the country, on Wall Street pay. They'd go bankrupt.
One question, people talk about more capital, but the point you make about return on equity and earnings per share being the driving metrics for executive compensation and other, higher employee compensation, doesn't that inevitably make all the banks say, well, we have to reduce the number of shares through buybacks and other means, because that's the best way to get return on equity and earnings per share up, is to shrink your capital base as far as you can shrink it without getting the regulators to put a gun to your head.
Yeah, no, that's one of the reasons why I say I think trying to run a company for shareholder value is not something I would recommend. I mean, I think it's dangerous, and it does lead to share buybacks, capital minimization, so forth and so on. I'm a kid from the Midwest in some ways. I basically say, look, if you have a business that depends on a set of customers and you can satisfy the customers, you're going to earn a decent return. And you don't need to bet the bank. All you need to do is satisfy a set of customers. When I joined Citibank, we were only allowed to do business in the city of New York. We were not allowed to go to Westchester. We were not allowed to go to Long Island. And all of that changed. And that, by the way, led to the interest that banks had in lobbying. Before that, there was no need to lobby. We didn't care. We were just doing our little business. But all of a sudden, the laws defined your business opportunity. And the Southern banks were much better than the Northern banks at lobbying. And we learned that when they got permission to go into regional banking, when the big banks were, the money center banks were excluded from all this. So the presence that various people in today's conference have talked about with banking as lobbying entities and so forth and so on, all of that stems back from the 70s when the arguments were, what was the scope of our banking opportunities? And it was very difficult to watch somebody from North Carolina have the ability to bank across the country when the fact that you were in New York meant that you couldn't. And so people said, okay, we'll go to Washington and convince them that we need to be given that same permission.
Hey, John, I was wondering, some people say we're in the age of the imperial CEO, and in the banking arena, I'm wondering what your thoughts are on whether or not the boards of directors can be effective in reorienting some of the prioritization away from shareholder short-termism to maybe customer-centric, or if that's just, no matter what you do, it's somewhat hopeless to actually have expect or have empowered directors.
No, directors, I've been a director of a lot of companies. One of the benefits of having been in my job is, I was the director of other companies. Directors, if you have a board who wants to assert itself, that is the defining thing. And now you could have boards that are just happy to tell their wives that they're on the board and you pay no attention to what's going on. But no, board of directors are extremely important. And if they feel that a company has lost its sort of values and that a different set of values would be better, they will either convince people to change or they'll change the management. And there are any number of cases where boards have changed management because they wanted a different vision of where the business should be going. And so, no, boards work. And I'm not saying all boards work or even that most boards work. I don't know. Yeah. But I've been on boards where we made big differences. And let me tell you, I paid attention to my board.
Yeah, I think many people think, and I think Art's written about this too, is that bank boards seem to be, I don't know, relatively speaking, if they're unduly solicitous, but certainly solicitous over the last couple of decades. And I think, not to pick on one bank, but I think the Wells Fargo board in the Stump years and in the post-Stump years was remarkably, many people have said derelict. And frankly, even the board would not even change over until they were basically forced to do so by the members of the House Financial Services Committee, notwithstanding a 20-year record of really quite broad-based and deep customer abuse. So I think there's a lot of people who have some questions about whether or not big bank boards can actually understand the business, be effective checks on CEOs.
Well, can understand the business is one question. They will certainly not understand the risks. Let me tell you that they cannot go over security positions and evaluate whether the company's risk-based models are accurate or not accurate. And a subcommittee of the board can't do it either. I mean, if you aren't a practitioner, you just don't get it. They certainly understand capital and liquidity. But whether a board can, in fact, cause the enterprise to embrace a set of values with which they're comfortable, the answer is absolutely yes. As I say, there are a lot of boards that are social. You just like to tell your wife, hey, I'm on this very important board, and we take trips to Australia once a year, and it's wonderful.
Well, and the pay for directors now is astronomical. It's nothing to get $300,000 or $400,000, $500,000 for serving on a board.
I hate to tell you, the job and the risks get up there too. I would not recommend that somebody go on a board who thought he was on a vacation. No,
You know, we're almost out of time. We've got a few more minutes, and there's been a lot of time spent today during the conference talking about the downsides of megabanks, but not so much on the upsides, the potential upsides of not having megabanks. And Art, one of the interesting things in your book that I found was the argument that, however you want to phrase it, whether it's a new Glass-Steagall or the separation of some type, would actually promote greater competition in both commercial banking sector and the capital markets, including in particular benefits for community banking and communities. So, Art, I was wondering maybe you could talk a little bit about that. And John, I'd like to get your thoughts on what you think about the potential benefits as Art sees them.
Well, I do think that by breaking up, the number of really large, national global institutions into a larger number, you would have a more dynamic system. I think that if something like Glass-Steagall was brought back, I wouldn't expect to see the largest banks dominate so much of the banking system as they do. I think you'd have a more diverse group of mid-sized and smaller banks, which, I grew up in a small town. I mean, smaller banks are really the lifeblood of smaller towns. And particularly, as John says, if you're a company and you don't have a credit rating, you really rely on bank finance or something, I think, much more costly and much less attractive. Internationally, my view is, and this is kind of based on my memories of the 80s, 70s, 80s, and 90s, that you had large banks like Citibank and you had large independent securities firms, and they competed against each other in the wholesale finance sector quite aggressively, and they were better competitors abroad than the big universal banks in places like Germany, the big Japanese banks. So my view was that it was a more dynamic, more competitive, less congealed system, and that we were very successful abroad. John, do you agree with that? That in the 80s, 70s, 80s, and 90s, the U.S. banks and securities firms were the premier global competitors?
Yes, no, I think that's true. I mean, Hong Kong, Shanghai Bank always was they knew they had to get out of Hong Kong because they were very vulnerable, having, basically most of their business there. And so they spread their wings. They tried on various occasions to buy a bank in England, but they spread their wings, and they became very successful as an international competitor. But Bank of America, Citi, and Chase all competed internationally, and most of us were in all the same markets. In other words, there were very few markets that Citi wasn't competing with Bank of America and the Chase, and we had different approaches. And in Latin America, the Bank of Boston was the big competitor. They tended only to be in Latin America. But yeah, it was, and the American security firms were very successful as global competitors. The only real competitor, which unfortunately has not continued, was the Deutsche Bank. They were pretty much the only continental, UBS and the Swiss banks were mainly private banking institutions in Switzerland. The Japanese banks never became successful major international banks. Some of the Canadian banks in the Caribbean became very important and very good, but there was a lot of competition. There was no place where you didn't have to fight for your breakfast.
Well, then maybe there's agreement there that whether it's a separation physically, or frankly, if you make the biggest of banks internalize their risk-taking costs more by materially increasing liquidity or capital, as you say, John, I mean, one of the inevitable outcomes should be greater competition, you would think.
Well, there's a lot of competition even today. I mean, the big banks all compete with.
I'm going to tell you, Phil, that Grace left the apartment at around 4 o'clock and everything.
I have a phone call.
As I said, I am going to try you, Phil. Bye-bye.
I'm sorry about that. My secretary.
It's the world of Zoom.
Yeah. I'm sorry. But no, look, there's a lot of competition even today. But when you go back to Art's key message, the financial sector is a risk. It continues to be a risk. I think the risk is in the capital markets themselves. You can isolate the banks from them or not, but we really do have to be aware of the risks that are in those markets and how can we live with those risks.
And what do you think if so? We're just about out of time, but when you say more capital and liquidity, everybody's debating the level of capital. Have you ever thought about what you think, roughly speaking, a range of what adequate capital would be?
I don't know. I mean, in the old days, we used to think 10% of your risk assets, but we defined risk assets as any asset not issued by the government. And we didn't have all of these models. As soon as you start assigning risk to tradable instruments, and by the way, marking to market, which banks did not used to do. We had our loan portfolio, we carried it to maturity. We didn't mark it to market. But as soon as you start trying to assess risk in tradable instruments that are marked to market, you're beyond my pay grade. I mean, none of us know. I mean, they used to say 3 sigma events only happen once every, I don't know, except they happen frequently.
Right. Long-term capital management was one of the first mark-to-market type operations, right? On a big scale, right? Enron was another one, right?
Yeah.
Yeah. Well, unfortunately, 3 sigma events are coming around more often than blue moons. So unfortunately, now I thought Erik was going to come back on as the unbelievably robust moderator to make sure we stayed on time. But before I hand it off to Erik, let me first thank you, John and Art. And it really, we'd be greatly remiss not to thank Erik for what has been an unbelievable amount of work to pull together this many people for a one-day conference. And the more remarkable thing is to keep them on time. I mean, that alone is maybe Nobel Prize worthy. But thank you, Art. Thank you, John, and Erik, off to you.
Thank you, John. Thank you, Dennis. Thank you, Erik.
Art, great to meet you and talk with you.
Great. Thank you so much.
Thank you all three, John, Dennis, Art. That was truly amazing. I was having a dialogue with one of our colleagues offline, and she described this conversation as mind-blowing, and I completely agree. I think it's fairly amazing that a lot of what academics are calling for and current people on Wall Street are calling heresy. We have John Reed here saying that this is just sort of common sense. Everything from stock buybacks are not necessarily the best policy to boards ought to set the overall values of an organization and not totally focus on shareholder wealth maximization all the time. So thank you for a truly enlightening conversation. I could let you three go on for hours, but I'm afraid of what the billable rate would be, and certainly more than I have in my bank account. Let me say a few final words of thank you for everyone who participated today. Thank you to all of our panelists, ending with some heavy hitters all the way through the end. Thank you to the law review students at the University of Colorado who helped make this event possible, some of whom were with me at the very beginning at around 6:45 Mountain Time, which is, if you're in your 20s, is pretty early. Thank you in particular to Jeremy Pam, who played a huge role in organizing today's conference. We owe you a lot, Jeremy, for all you've done, including helping with this conference. Thank you to Yesenia Delgado, who has been helping do all of the tech support. Yesenia was also here well before 6:30 in the morning and is still here at 3:30 Mountain Time. So thank you to Yesenia. I'm going to make sure that our outgoing and incoming deans know just how helpful you've been. And lastly, but not least, Art. This was all your doing, Art, right? So I would list all of the panelists by name, but it would take a couple minutes. The next time we have a conference over your next book, Art, we're going to spend a little bit more time roasting, right? So none of this. I love you, Art. You've been helpful mentoring me. We're gonna actually get him some zingers.
You'll get to the real truth, right?
Exactly.
Thank you so much, Erik, and thanks to everybody.